Okay, ladies and gentlemen, it's time for our discussion of competition and monopoly. Now, when I was studying economics back in school many years ago, when we discussed issues related to monopoly and how competitive markets are, a lot of that discussion was sort of backward-looking. We talked a lot about John D. Rockefeller and Andrew Carnegie and Cornelius Vanderbilt and the so-called robber barons of the 19th century, early 20th century. But it was thought that markets had become much more competitive since then. Oh no, monopoly is back with a vengeance. So Senator Warren, for example, has made one of her primary part of her platform in her election campaign is that big tech companies, Amazon, Google, Facebook, and so forth, have become too large and need to be broken up through aggressive sort of antitrust policy. Even, Trump's Department of Justice has already started a new set of investigations of market concentration and abuse of monopoly power, particularly by tech companies. You know, if you're not sure how all this works, you can always find a convenient explainer on Vox.com. So you can, Matthew Iglesias will be happy to Vox-splain for you everything that's going on. But it's a little bit weird if you think about these issues from sort of a common sense perspective, right? I mean, what do we mean by competition in everyday language? I don't know if any of you were able to watch it with travel and so forth, but on Sunday morning, Roger Federer and Novak Djokovic played an epic Wimbledon men's final match. It was 5 hours and something, the longest men's final in Wimbledon history, and the first one ever to use a new rule that they instituted this year of having a tiebreaker in the fifth set if it gets to 12-12. So they got to 12 games each in the fifth set before playing this a tiebreaker, and Federer, who is, 37? Hung in there till the very end and lost by a hair to Novak Djokovic. And we would say, commentators did say, this is one of the most competitive men's finals ever. This is a great example of sporting competition. What a fantastic competition between Federer and Djokovic. And in the semifinals, Federer beat his longtime rival, Rafael Nadal, in another epic match. But how many competitors are in these tennis matches? 2. What do your professors tell you about a market in which there are 2 competitors? It's a duopoly, right? It's not competitive at all. We normally think competition means, an effort to beat somebody, to do better than your rival. In school, you're competing against other kids, or you enter the spelling bee, it's a competition. You're in the band competition or a sporting competition. We sometimes use the adjective form to describe a competition that is particularly intense, right? That was a really competitive match. It was really close. To get into college, the college of your choice, you've got to pass a really competitive entrance exam or whatever. Obviously, this is not the way these terms are used in mainstream economics textbooks. Now, legally, right, in common law systems, there was an understanding of monopoly. In the natural law tradition, to use Judge Napolitano's terminology from last night, that a monopoly was an exclusive grant of privilege that was conveyed by the ruler, by the king, by the sovereign, right? So, the Dutch East India Company had a monopoly on trade between Amsterdam and the East Indies. What that meant is it was illegal for anyone else other than the Dutch East India Company to sail ships around to Indonesia or whatever it is and bring back cinnamon and nutmeg. The Royal Navy would fire upon you and sink you. You'd be thrown in jail, your goods confiscated if you attempted to do that. And sometimes even today, if you buy, you buy some, I don't know, if you go to London on a school trip and you buy some little cookies or biscuits at the gift shop, and it says on the back, by order of Her Royal Highness, officially licensed, shortbread to the Queen or something like that, right? So that's what monopoly traditionally meant. It means you don't have to compete with other firms or producers or as many other firms or producers because the state has made it illegal for someone else to compete with you. Oh no, not in mainstream economics, right? In neoclassical economics, we have a whole different kind of language to describe competition, models of so-called perfect and imperfect competition. The definition of competition in these models has to do with essentially the ability of firms to charge prices that are higher than their marginal costs, for reasons that we'll see in just a moment. The Austrian School, not surprisingly, takes a different approach, or has taken some different approaches to the understanding and definitions of competition and monopoly than the neoclassical economists, and I'll explain in just a moment what those are as well. Okay, so in your undergraduate economics textbooks, you probably have chapters on competitive markets and non-competitive markets or imperfectly competitive markets. And the idea here is it's kind of an empirical exercise, right? So we look at a particular market in a particular place, say, the market for toothpaste in Auburn, Alabama, and we say, okay, what kind of products are sold? Is there kind of a generic toothpaste, and there are lots of different firms selling essentially what are perfect substitutes? Or is it a market with differentiated products, where a tube of Crest is completely different from a tube of Colgate or whatever, in which case each firm has a monopoly on its own brand, right? Are there lots and lots of buyers and sellers, or are there just a few buyers or just a few sellers? How easy is it for a new company to get into the market? Not only looking at the issue of legal privilege, like we mentioned before, but even if it's just economically difficult to get in, right? I mean, there's no law that prevents me from setting up an online retail business and trying to compete with Amazon, but I'm not going to do very well, at least not at first, and probably not at all if I'm just selling general purpose goods. So mainstream economists would say, well, there's Amazon's existing size and brand penetration constitutes an entry barrier. And so new firms can't come in, and therefore that market's not competitive. What do people know? Is there perfect information, asymmetric information, and so forth? So, that's why your textbooks say, well, the wheat market is pretty competitive or almost perfectly competitive because wheat is just wheat. You don't care which farm it came from. There are lots and lots of sellers of wheat. There are no particular entry barriers to getting into wheat. Of course, none of that is actually true, right? There are lots of different kinds of wheat. There are different grades of wheat, and of course nowadays there's organic wheat and GMO-free wheat and wheat made with sustainable farms paying a living wage. There's all different kinds of wheat, so it's not even true. But your textbooks use like agricultural commodity markets as examples of things that are sort of close to perfect competition. Or you could have a market like the market for large body commercial aviation, which is where there are basically just two firms, Airbus and Boeing. There are some smaller firms of the firms that make the little jets, like Embraer and so forth, that are starting to build bigger ones. But for wide body planes, really there's just two firms. Or in a market like the market for internet search, where according to your textbooks, there's only one firm, Google, right? Google has basically 100% of the market for search. I mean, it's not really 100%, but when was the last time you binged something to find out where it was or how to do it? Not very often. So markets, real world markets can be characterized according to the conventional wisdom as being either perfectly competitive, oligopolistic, or monopolistic. And according to the conventional analysis, there's some important welfare implications that flow from that and implications for what the government ought to do about it. How many of you have seen a picture like this before? Raise your hands. Yeah, most of you, right? So the so-called perfectly competitive firm of economics textbooks, this is one firm, one little wheat farmer selling wheat to the wheat market, and there's millions of wheat farmers, so no individual farmer is in a position to drive up the price by withholding his wheat or drive down the price by bringing a few extra bushels to market. So these firms are modeled as price takers, quote unquote, right? Each firm faces a perfectly elastic demand curve. And if firms choose to maximize their profit by producing where marginal revenue is equal to marginal cost, you get the prices and quantities that are given here in this graph in equilibrium. And in the long run, right, if the market price is high enough that firms are earning economic profits, other firms will come in and drive those profits down by expanding industry output. If firms are making economic losses, they'll begin to exit, and that exit will reduce the supply and help to drive the market price up until you get this long run equilibrium where everybody's exactly breaking even, right? So price is not only equal to marginal cost in the short run equilibrium of this model, but in a long run equilibrium, prices are reflecting the average cost of production. So this is the most efficient way to distribute resources in society, right? This is the thing that you got for several weeks probably in your intro econ class. But, you know, sinister sounding music now, some markets are not like that because some firms can have so-called market power, right? What's market power? Well, as I suggested before, it's supposed to sort of capture the ability of a seller to charge a price that's higher than marginal cost, right? Why? Well, because this seller, by definition, is the only seller in the market, right? So, for example, this search engine is the only search engine in the market, so it can charge a very high price for search. Oh, wait a minute, search is free. I gotta go rethink that. Okay, there's a hypothetical monopolist, right, that is the only provider of this product in the market. So, you know, the downward sloping demand curve for the industry is also the downward sloping demand curve for this firm's own output, because it's the only firm in the industry, according to this story. Right, so rather than the individual firm facing a perfectly elastic horizontal demand curve, it faces a downward sloping demand curve. And so when it charges a price where marginal revenue is equal to marginal cost, it's, right, that's this price, here, the monopoly price is up here, where the marginal cost curve, the blue line, intersects the downward sloping green line, the marginal revenue curve, right? That gives you the monopolist quantity. And then you go up to the demand curve to find the monopoly price. So the argument is, if this industry were perfectly competitive, like the one on the previous graph, the industry quantity would be QC, and the industry price would be PC. But because only one firm controls the whole industry, that firm can restrict output, deliver less to the market, jack the price way up, all the way up to PM, right? So you get the firm earns some monopoly profit, but the benefits to consumers are reduced, less so-called consumer surplus, and you got this whole little guy here, the so-called deadweight loss triangle, which is supposed to represent some inefficiency in the market. So you get prices that are too high, outputs that are too low, deadweight loss. This is terrible. We cannot allow this to go on. Right, so what should we do? Well, sometimes the textbooks are a little bit vague on this, but it's implied, if not outright stated, that the government either needs to force the firm to charge a lower price, just compel it by law to charge a price that's closer to the so-called competitive price, increase its output, or maybe break it up, right? Use antitrust to split this firm into how many? Well, 2, 3, 5, it's not gonna cut it. It's supposed to have like an infinite number. It's a little bit hard to do in antitrust, but the point is the government needs to do something to make this market structure look more like the one on the previous slide. That's what you get in a standard micro course. Well, it turns out, I've sort of hinted at this already, right? Even within the framework of neoclassical economics, there are a number of difficulties with the standard kind of so-called market power approach. So one kind of criticism that was offered famously by Joseph Schumpeter, but also by others, is that, look, even if it's true that in the short run you get some kind of allocative inefficiency, some reduction in consumer well-being from having monopoly markets like the ones on the previous picture, that's kind of the price that we as a society have to pay for innovation. Because remember, the perfectly competitive firm, the wheat farmer in this perfectly competitive industry earns zero economic profit, right? Gets just enough financial return to cover his opportunity cost, but not a penny more. So that farmer doesn't have any money left over to do anything like research and development, right? Who's going to invent new GMO seeds or GMO-free technologies? Who's going to invent new tractors and fancy computerized GPS-enabled plowing devices? Who's going to come up, use fancy genetics to make Roundup-ready seeds and so forth? Well, the farmers can't do that because they don't have any money. They don't have any retained earnings. They don't have any profit. According to Schumpeter, we need to allow some monopolies because monopoly profits can be used for things that are socially beneficial in the long run, like R&D. Okay. Other mainstream economists, like the great UCLA economist Harold Demsetz, argued that, look, the standard way of looking at it misses one important fact, right? Why is it that Google has a very large share of the search market? Why is it that Netflix has a very large but decreasing share of the market for streaming video? Why is it that Uber and Lyft between them have most of the market share for ride sharing in the US, but not in other countries, right? Well, it's because they're good at it. Because the thing they offer is better than the thing that rivals offer, right? We as consumers prefer to use a Google search. There's no law that prevents us from using anybody else's search technology, but we don't. Most of us don't because we don't like it. We don't like the results. It's not as useful. I mean, and of course, notice that in a free market, even if one firm has a large market share, nothing prevents consumers from patronizing other firms with smaller market shares. Now, I suspect in a crowd like this, there are at least a few highly paranoid privacy enthusiasts who, don't use Google products, or you use DuckDuckGo for your searches because they don't track you. And then that's fine. You can certainly do that, right? But the masses like the convenience of Google. So Demsetz argued, if you essentially punish firms for having a large market share by breaking them up or regulating them, then no firms will have an incentive to be large. And how do you get large? By being good. By being efficient, having low costs, producing stuff that people want, and we don't want to penalize success. There was, back in the 1980s and 90s, there was a popular theory that was offered by William Baumol, among others, who was the person I mentioned yesterday with that quote about the ghost, the specter haunting economic theory, the missing entrepreneur. Baumol and some of his colleagues pointed out that really what matters, or one of the things that matters for determining how competitive a market is not the number of firms who are currently in the market, but the number of firms who could easily get into the market if necessary. Right, so, if here in Auburn, Alabama, if there's only one firm selling, lemonades or whatever. I don't know if you guys know, there's a famous place down in downtown Auburn called Toomer's Lemonade, Toomer's Drugstore. They sell a famous lemonade. If Toomer's is the only place selling lemonade in Auburn and they jack up the price to, $20 a lemonade, well, then it would be in the incentive, that would be an incentive for, individuals, companies in Atlanta, in Montgomery, in San Francisco, who knows, from all over the world, to converge on Auburn, Alabama, and start offering lemonade that's just as good as the Toomer's lemonade at a much lower price. Right, so if Toomer's knows, and look, this is lemonade we're talking about. It wouldn't take more than 10 minutes for somebody to come up and set up a competing lemonade operation. Okay, Toomer's knows that if it raised prices beyond a certain level, other people would just rush in, and therefore Toomer's doesn't ever do that. Right? It doesn't ever take the action that would trigger these new firms coming in. So the presence of potential competitors can discipline pricing behavior by incumbent firms, even if those potential competitors are not actually in the market yet. They could be in the market. Some economists at the University of Chicago have been in the econ Twitterverse in the last week or so, because they've got a new book coming out called Chicago Price Theory. This is like a graduate level text that is supposed to incorporate the contents of the legendary intro microeconomics course at the University of Chicago. And some other economists quoted out of context a line from this price theory text where the author says something like, well, perfect competition is a reasonable approximation in most markets, for doing certain kinds of analysis. And all of these sort of non-Chicago mainstream economists with large numbers of followers started dunking on these people and saying, oh, this is the most idiotic thing ever. Who thinks that real world markets are perfectly competitive? These Chicago guys are out of their minds. Really, all the authors meant was that perfect competition is a useful analytical tool. They weren't making an empirical claim about markets, but they were saying, the standard model of competition is okay, even though in reality it doesn't describe real markets. Okay, these are perfectly fine criticisms, but they're not fundamental. They don't get at the heart of the problem the way, spoiler alert, the Austrians have done so. Okay, so what are some Austrian critiques of the standard kind of market power approach? Okay, so first let's talk about this idea of the perfectly elastic demand curve, the horizontal demand curve versus downward sloping demand curve. Rothbard pointed out in Man, Economy, and State, there is no such thing as a perfectly elastic demand curve. Right? Every seller contributes some discrete quantity of goods and services to the market, right? Even if doing so doesn't have a huge effect on price, it doesn't have a zero effect either. Remember, in Austrian causal realist analysis, we don't think of mathematical approximations where we have perfectly smooth and divisible curves, twice differentiable curves, and so forth. We don't think in terms of infinitely large or infinitely small units or periods of time or whatever. We're studying the world of real human action. Human action takes place in discrete increments in real time, right? So in the world of purposeful human action, there are no infinitesimally small units, and there's no way to have a mathematically perfectly elastic demand curve, right? Anytime a new seller enters the market, or anytime a seller brings a new bushel of wheat to market, that has some potential impact on market price. So this whole notion, all sellers have a downward sloping demand curve. So we can't ex ante say this market is competitive, this market is not competitive just by looking at the shape of the demand curve facing the firm, okay? Second point, it sounds like a normative point, but it's really just a positive one. Requiring firms with antitrust or regulation to increase output beyond the profit maximizing point, that so-called monopoly quantity in the traditional monopoly graph, is actually a violation of people's property rights, and therefore a reduction in social welfare in the meaningful sense that Austrians use terms like social welfare. What do I mean? Well, it's easy to see with an example like the following. I looked it up last week. In 2018, the last year for which complete data were available, the highest paid movie star in Hollywood was my doppelganger, George Clooney. I forget the number, but it was a big number. But we all know that, I guess if you read the tabloids or whatever, every once in a while George Clooney is spotted, at the beach or going into a store or hanging out at home or at a party. He's not working making a movie every single moment of every day, right? Obviously, his services are in high demand. So you could argue, well, under perfect competition, right, the market would demand a larger quantity of George Clooney films or scenes in movies with George Clooney in them, however we measure that, than the one that we actually have, right? How does George Clooney manage to get, 25, 30 million a picture? Because he only does so many pictures a year. He makes himself artificially scarce, right? If he were in the studio every single day, if he were in every movie, if he were in every single TV show like, Samuel L. Jackson, right? His market price would go down because he's sort of super abundant. So, any celebrity, entertainer, artist, skilled professional deliberately withholds some of their supply from the market so that they can command a higher price. That's exactly what the non-competitive, producer in the standard model is supposed to be doing, restricting output below the perfectly competitive level to jack up the price. But nobody thinks we could increase social efficiency somehow by compelling George Clooney to work every single moment of every single day. Well, should we compel Jeff Bezos to produce more, to offer more Amazon products and services to the market than he is currently offering? I mean, by the same argument, right? Jeff Bezos and his shareholders, the owners of the assets of Amazon.com, are using those assets in a way that, in their minds, is, they're attempting to maximize their profits. It wouldn't make sense to say, well, they should be compelled to, instead of producing QM, they should be compelled to expand output to QC because that will reduce deadweight loss. I mean, that'd be just like saying George Clooney should be forced to make more movies to reduce deadweight loss. It doesn't make any sense, right? It's a violation of owners' ability to make decisions about how the resources they owned should be used in the highest valued ways, okay? Another point is that, the shape of the demand curve, the elasticity of the demand curve, which mainstream economists make a big deal about, that is not given by nature, right? You students know the elasticity of demand reflects the sensitivity of market prices to changes in quantity, right? It represents changes in quantity, how sensitive are quantities demanded to changes in market prices. Those are preferences of people in the market, right? So if consumers want, if consumers want to make the demand curve more inelastic, they can do so by adjusting their behavior, by changing their willingness to buy or not to buy depending on the market price. So elasticity of demand is itself an economic concept, not a sort of a technical concept. People say, well wait a minute, isn't demand elasticity caused by the availability of substitutes? Right? If you're a smoker, you got to have cigarettes. There's there's a patch and chewing tobacco and the e-cigarettes and all that. Well, those are not a good enough substitute. Therefore, the elasticity of demand is very small for cigarettes. They have very inelastic demand, and therefore cigarette makers can charge high prices. Well, what things are or are not a good substitute for smoking a cigarette, that is 100% in the minds of cigarette consumers. Okay, they can choose whether something is a substitute or not. That's not a technological concept, that's an economic valuation concept, okay? As I think Joe Salerno mentioned in his opening talk on Sunday evening, Mises and Rothbard had a slight difference of interpretation on monopoly theory. I think Joe mentioned this as well, that in Mises' understanding, it was sort of conceivable that a firm could charge monopoly prices if it had exclusive control of a particular resource or factor, right? So you could imagine a case where there's a single seller of a good or service, or a perfect cartel among sellers of a good or service. And if, according to Mises, if the demand curve is inelastic above the competitive price, the price that would have obtained under other circumstances, then firms can actually charge prices that are different from competitive prices, so-called monopoly prices. As Joe pointed out, Mises thought that this was, in a sense, a violation of consumer sovereignty. Consumers would prefer a higher quantity on the market. So, when Mises talks, as he does in many places, about the entrepreneur is not the captain of the ship, the consumer is the captain of the ship, and the producers are producers are compelled to try to satisfy the wants of the consumers and so forth. Mises says, well, this is one possible exception where consumer sovereignty does not obtain, but Mises thought this was, in practical terms, very unlikely to occur in a free, unregulated market. Right? Because, again, what does it mean to be a single seller? I mean, what is or is not a substitute is subjective. Cartels are very rare on the market. They typically break apart. So Mises didn't think this was very common, but he did think it was sort of a theoretical possibility. Rothbard basically accepted Mises' approach to monopoly, but with some refinements. Right? Rothbard, as I suggested before, pointed out that all sellers face a downward sloping demand curve. According to Rothbard, there's really no way praxeologically to distinguish a monopoly price from a competitive price. There are just market prices, okay? All firms are trying to maximize their net income given their estimates of future consumer demand. all firms price in the elastic range of their demand curve, right? They would never price in the inelastic range because if so, they could raise price even more and increase their total revenue, right? And if they're selling less quantity, they'd also be lowering their costs. And as we pointed out before, elasticity is sort of the result of consumer preference. So Rothbard thought that not only is monopoly, as Mises defined it, extremely rare on the free market, it's really not even conceptually distinguishable from any other kind of market phenomenon. So Rothbard rejected the idea of monopoly prices as things distinct from competitive prices. There are only prices on the market, according to Rothbard. And of course, in Rothbard's view, as many of you know, he accepted the common law notion of monopoly as an exclusive government grant, right? So, in some cases, that could be like the post office. It's illegal for anybody else to send a letter or use a postal mailbox, or the East India Company, like I mentioned before. But monopoly, government-granted monopoly, is also reflected in patents, right? A patent grants the patent holder a fixed-term exclusive license to use that technology or produce that product. There can be all kinds of grants and charters and licenses, even tariffs and quotas, other kinds of trade protectionism, et cetera, give some de facto monopoly protection to domestic firms because they don't have to compete against foreign firms and so forth. So what do the Austrians say about these sort of proposed regulatory and antitrust solutions to monopoly issues? As I mentioned before, in the standard approach, in the mainstream neoclassical approach, there's sort of two possible remedies that the government should use to deal with the problem of monopoly prices. One is to use regulation, right? Just pass a law that says the price cannot be higher than X, right? So you could try to force the monopolist to lower the price that it's charging to something closer to the actual marginal cost, right? Just, pass a law. Two obvious problems with this approach. I mean, first of all, it's easy to draw a silly diagram like your professors do and your textbooks do and say, oh yeah, where these lines cross right here, that's what the price should be. Okay, but remember, demand curves, marginal revenue curves, marginal cost curves they don't exist in reality. Those are abstractions constructed by the analyst. I mean, firms don't know what their actual marginal revenue curve is. They can estimate their marginal cost curves, right? How in the world is some government regulator going to know how the price that we actually observe on the market compares to some hypothetical pure monopoly price, some hypothetical perfectly competitive price, some intermediate oligopoly price? There's no way that even a well-intentioned government regulator could possibly know what the right prices are, okay? Moreover, why would these regulators have an incentive to get the prices right? Okay, as Harold Demsetz, who I mentioned before, and Ronald Coase often emphasized, the textbooks usually have page after page, chapter after chapter on so-called market failure, like monopoly, for example, and they probably don't devote a single page to government failure, right? I mean, the regulator is going to get things wrong. The regulator could be corrupt. The regulator has a short time horizon. The regulator can easily be bought off. Regulators can be captured by the industries they're supposed to regulate, and so on and so on and so forth, right? So, in other words, even from a neoclassical economics perspective, even if you thought monopoly prices were somehow harmful, you might think that setting up a super powerful government entity with the right to tell firms how to price, or the ability to take a firm and break it up into pieces, would be even worse than just allowing monopoly prices to prevail, okay? You can't compare the real world market against some stylized hypothetical benchmark like perfect competition unless you're also going to compare the real world regulator to this hypothetical perfect benevolent regulator in the textbooks, okay? But hardly anyone in the mainstream ever does that. So again, second approach, instead of using price regulation, is just to use some kind of antitrust, right? So in the US, you have the Sherman Act and subsequent pieces of legislation that outlaw certain things that are not very precisely defined. Okay, the Sherman Act outlaws restraints on trade. Now it's been up to the courts, including on and up to the Supreme Court, to define what constitutes a restraint on trade, because it's not completely obvious. There are other practices like so-called price discrimination, charging different prices to different buyers, so-called tying, telling the buyer, if you buy my product A, you've got to buy my product B that goes with it, which have also been restricted or completely banned by other acts, like the other legislation like the Clayton Act, laws that specifically deal with so-called predatory pricing and so forth. In the European Union, competition policy is a little bit more aggressive than it is in the US, but founded on the same general principles, and certainly in most parts of the world, you have a so-called competition authority, the job of which is to police the market and make sure markets are competitive in the neoclassical sense, using in particular antitrust policy and similar kinds of remedies. As I mentioned to you guys before, when I was in school back in the 80s and 90s, what I learned was, oh yeah, people were really concerned about monopoly pricing, and aggressive, and antitrust was really aggressive in the early 20th century to bust up these evil monopolies and so forth. But now markets are pretty competitive, and antitrust doesn't have that much to do anymore. That in the last, I'd say, even within just the last decade, maybe 2 decades, there's been a radical change in how mainstream economists and legal scholars think about antitrust. So back in the, from say the 1940s to the 1970s or 80s, the dominant theoretical paradigm in the analysis of antitrust was something called the structure, conduct, performance paradigm, or SCP paradigm, which held that you can look at the structure of any market, count the number of firms, or look at the market shares of the biggest firms, and therefore deduce whether that market is in fact competitive. If the market has the wrong market structure, it's too heavily concentrated, then the conduct of those firms will be, they'll charge higher prices than they're supposed to, and then the performance in that market for consumers, for the economy, is going to be weak. And so antitrust needs to look basically at market structure, concentration indexes. Some of you have heard of the famous Herfindahl index of concentration. That basically the antitrust authority's job is to measure the Herfindahl index in different industries and then recommend antitrust breakups if the Herfindahl index is too high. Okay. That view really kind of intellectually was severely challenged in the 70s and 80s and kind of fell out of favor. There was Oliver Williamson's transaction cost approach to market structure, which held that many practices, both in terms of sort of horizontal market share and vertical integration, that deviate from the perfectly competitive model are not in fact harmful and welfare reducing, but are actually welfare enhancing because they promote more efficient coordination among firms and between firms. They allow us to produce things more efficiently and actually make prices lower than they otherwise would be, and increase consumer well-being. And of course, there was the Chicago School, 60s, 70s, and 80s, associated most famously with people like Robert Bork, who was nominated for the Supreme Court sometime in the mid-80s, and in a famous, probably one of the first sort of really vicious Senate confirmation hearings, was turned down by the Senate, by the whatever committee it is, for a position on the Supreme Court Judiciary Committee. And that gave us the verb to bork someone. It's kind of like, and nowadays, in your generation, you have words like, you have new verbs like dox, like to dox somebody or gaslight somebody. Back in the 80s, we talked about borking someone. To bork someone means basically to attack them viciously in some kind of political process in a way that's not really fair. Right? So Bork was criticized for a lot of things that were not even remotely close to his actual views. But the idea was that the Chicago School had challenged the ideas of the old structure, conduct, performance paradigm, like some of the things I said before, that potential competition may be as effective as actual competition, that large market share may reflect superior efficiency rather than some kind of devious manipulation of the market, and that therefore antitrust courts should have a presumption in favor of the defendants. In other words, it should be pretty obvious that some kind of anti-competitive conduct has taken place for the Justice Department or the plaintiff to win. We should have a presumption in favor of competition, and only in very rare cases should we accept that markets are actually imperfectly competitive, or that they're sufficiently imperfectly competitive that antitrust should be used. In the 90s and 2000s, the theory of antitrust and regulation, the whole theory of market structure, was sort of revolutionized by game theory. So how many of you had a course where they talked about duopoly or oligopoly using the prisoner's dilemma or some kind of a game theoretic model? A lot of you. So the game theoretic approach was sometimes called post-Chicago, not only because it was developed later than the Chicago School, but also because it challenged many of the conclusions of the Chicago School. And so-called post-Chicago antitrust, game theoretic antitrust, is much more friendly towards aggressive antitrust. Nowadays, something has emerged that is sometimes called hipster antitrust, or neo-Brandeisian antitrust, after the famous Supreme Court Justice Louis Brandeis, who was very favorable to strong antitrust. There's an activist, I would say, like a nonprofit journalist activist person named Lena Khan, who wrote a law review piece, I think it was 2 years ago. It's called, I forget, something like Antitrust in a Post-Amazon World. This is where Elizabeth Warren gets her argument, right? So the so-called hipster neo-Brandeisians say all of that stuff about antitrust in the old era doesn't really apply anymore. Because, as I mentioned with Google, remember the conventional argument has always been, monopoly is bad because they restrict output and charge higher prices. Okay, well, what does Amazon do? Charge lower prices for everything than you could get anywhere else. Google gives away almost all of its products for free. That Facebook subscription that gets on your nerves because they keep changing the privacy policy or whatever. How much do you pay for your Facebook account? Right, so you can't argue that firms with large market shares in the tech sector are exploiting their market share by raising prices, because they're not. They give all their stuff away for free, or they charge prices lower than the incumbents. So Lena Khan and other antitrust scholars have said, well, we need a whole new way to look at it, that these firms are anti-competitive because, here's the kind of argument you hear. Amazon, and as you guys probably know, Amazon's biggest revenue source is not the commissions that it charges on stuff that you buy and sell on Amazon.com. It's the money it makes from Amazon Web Services, its back office sort of web hosting operation. So the argument is, these large tech platforms, they charge higher prices to other companies in the wholesale market than they otherwise would. And they engage in this pretty aggressive practice of buying up competitors. If some little firm comes along and it has something that facilitates e-commerce or web services, Amazon will just buy it up. And they've got huge cash hoards. Apple has, $1 billion in cash sitting in the bank. They can just buy up any firms that threaten their market position. And even though they don't raise prices, it's still harmful in the long run because they're holding back innovation, or they're hurting workers, or they're hurting some kind of intermediate goods firms and so forth. Therefore, we still need to break them up. Okay, so that is the zeitgeist today. And that's where you get most of the competition programs. Well, not only of the Democratic candidates, but the Republican economists and Congress people who are attacking Twitter and Facebook and so forth based on content issues are also making these same kind of claims. Everybody in Washington wants Facebook, Google, Amazon, maybe Apple, et cetera, split, broken up, okay? There are lots and lots of problems in practice with doing competition policy. I'll just hint at a few. First of all, what is the relevant market? Is the market for Colgate toothpaste, is a relevant market Colgate, in which Colgate has a 100% monopoly? Or is the market toothpaste, in which its market share is smaller? Is the market consumer health and beauty products, in which its market share is even smaller? right? Is the market for Amazon other online big retailers? Does it include Walmart or not? Is it international or is it domestic? So there's no way objectively to say what is the relevant market that we use to compute the market share. One of the most famous antitrust cases in the 20th century was called Brown Shoe. You can look it up, where Brown Shoe was a national retailer of shoes that had like a chain. They had a store in every town. The Justice Department, they wanted to buy another shoe company, another national chain, Kinney, and the Justice Department intervened to try to block the merger. And Brown Shoe argued that the relevant market is the local town, right? So the Justice Department said, well, if we allow these two national chains to merge, then there will be only one big national chain. That's not competitive. And Brown Shoe said, no, the relevant market is Auburn, Alabama, or whatever town. And if Brown Shoe is competing with small local shoe stores in Auburn, Alabama, then it faces competition. The competition is the local market. The relevant market is the local market, not the national market. The Supreme Court argued in favor of the government and not in favor of Brown Shoe. How do we know when conduct is really anti-competitive? If you can't look at prices, you got to come up with these highly speculative counterfactuals, like the one I just mentioned about Amazon. Well, if it weren't for Amazon, we would have had more innovation in web services and in retail, and we would have gotten even better stuff than we now have. Yeah, okay, I guess. I can imagine a world in which that is true. I can imagine worlds in which a lot of other things are true. Is that a basis for throwing somebody in jail, right? Or forcing them to divest their holdings or break up their company? Doesn't seem like it. You want to take a dynamic rather than a static view. A lot of firms, right? Remember, firms can file a civil antitrust suit. So firm A can file an antitrust suit against firm B for engaging in monopolistic conduct. Guess what? It's a great opportunity for firm A to engage, to use the political process to hurt its rival, right? To waste its rival's time, spend a lot of its rival's money defending itself in court. So there are a lot of opportunities for rent seeking. Can the government really keep up with changes in the market? There's a famous book from the 1980s about the US government's attempt to break up IBM in the 60s. The book's called Folded, Spindled, and Mutilated, which some of you old-timers will recognize that term. But basically what happened is the IBM was alleged to have monopolized the market for computer mainframes. And the Justice Department began what turned out to be something like a 10-year investigation. Judicial proceedings are slow. And at some point, 10 years later, the prosecutors finally realized, the thing that we claimed IBM had a monopoly in, the mainframe, doesn't exist anymore. Because now people use PCs and other devices, so let's just drop the whole thing. Right? The market disciplines so-called anti-competitive conduct much more quickly than bureaucracy. And of course, the problem is you can't define anti-competitive conduct ex ante. So if you're a firm, you don't really know if you've engaged in anti-competitive behavior until you get a subpoena in the mail. And so it's basically punishing behavior ex post that you couldn't have known about ex ante, and that's obviously inefficient. Okay, I did have a little piece I was going to say about minimum wages, but I'll defer that to Mark Thornton, who's giving a minimum wage lecture later. But I'll just mention that there's a parallel argument on monopoly pricing that applies to input markets that's called monopsony. And it turns out nowadays that most of the arguments in favor of minimum wages are not the traditional ones. They're about this kind of stuff. They say that large firms have monopsony power. They have buying power in the labor market, and they use that monopsony power to push wages down. And therefore, the government needs to intervene to make wages higher and get them closer to their competitive levels. But you can ask Mark Thornton about that during and after his lecture. So thanks very much.
Pictures on his phone.
That's good.
¿Cuál es el problema del sistema de salud en Estados Unidos? Las insurance no puede cruzar los estados, de que hay mucha burocracia. O en la administración de algunos
All right, let's begin, please. Hey, Dr. Klein. All right, please allow me to begin here. The topic on the table is free trade versus protectionism. Dr. Rittenauer's talk yesterday was an excellent introduction to this and laid the groundwork for this, and I'll try to build upon that. There's a lot of arguments over the last 200 years for protection, and I can't address them all, and I don't even think the Austrians, certainly Mises and Rothbard, have not addressed many of them, but they've given us this framework for thinking about these arguments, and that's what I'm going to try to explain today. Even though they've ignored some of the actual arguments, they've built this set of theories that we can use and apply to these arguments regarding free trade and protectionism. And it's a very timely topic, especially over the last couple of years with the Trump proposals on tariffs. I read, I think, articles almost daily attacking the Trump tariffs. It seems like most people are free traders these days. And it didn't seem to be the case under the previous two presidents. I'm not sure why this is the case. And there's all of these hostile arguments, and I'm not saying we shouldn't be hostile to these tariff proposals. This cartoon kind of represents the type of arguments we see, where we're all scared of the tariffs, and it's going to destroy the farmers and other sectors of the economy. But the argument for free trade is slightly more complicated than the argument against intervention in general. So Mises and Rothbard and others have concluded that government intervention does economic harm. We could spend 45 minutes quoting them on this. In his great 1956 article on utility and welfare economics, Murray Rothbard concludes, no government interference with exchanges can ever increase social utility. And he spends a great paper explaining this. But this does not counter the arguments for protection. This just tells us that tariffs harm the world economy. It doesn't tell us whether or not tariffs harm the world economy and benefit the U.S. So we can't use these same arguments. So at least a couple of times lately, I've read people attacking the Trump tariffs, and they've said, look, free trade within the 50 states has led to prosperity within the 50 states, which I agree with. But that doesn't counter the arguments for tariffs. That doesn't tell us whether or not an Alabama tariff on Tennessee products is good for Alabama. I mean, even if it's bad for the United States, is it good for Alabama? That's the economic argument. And you might immediately say, well, it can't be good for Alabama, but the question on the table is, can the government implement policies that transfer wealth from one region to another region? And don't we all agree that if they have political jurisdiction over both regions, that they can do this? If they have political jurisdictions over the United States, can't the government transfer wealth from one area to another area? So they can use the tariff. Multiple articles recently have explained that a tariff on steel will transfer wealth away from people who buy products with steel in it, and to the domestic steel industry. And they can transfer wealth from one region of the country to another. So if we read Tom DiLorenzo's work and other Austrians on the tariffs in the 1800s, we understand that the tariffs exploited the southern states and benefited northeast business interest. So the government can transfer wealth from one region to another region via the tariff. So the question on the table is, can they do it if they only have political jurisdiction over one region? So if they only have political jurisdiction over the North, could they implement a tariff that exploited the South and benefited the North? And so we can't just immediately reject this, because we already agree that they can use the tariff to transfer wealth from one region to another region if they have political jurisdiction over both regions. All right, so the standard answer that we tell all of our principles of economics students is that the law of comparative advantage tells us that this can't be the case. The law of comparative advantage tells us you won't benefit yourself with protectionist policies. This is, I assume that all of us that teach this have told our students this. And this is something economists agree on. Although it's rather complicated, it's not a law like the law of demand. There's a lot going on with the law of comparative advantage, but it's something we generally agree on. Paul Krugman says, if there were an economist's creed, it would surely contain the affirmations: I understand the principle of comparative advantage and I advocate free trade. And with apologies to Tom Woods for approvingly quoting Paul Krugman. This is pre-2000 Paul Krugman, when he was when he was writing stuff I think that we should be reading. And you probably know this. This argument goes back over 2 centuries. We usually credit, many of the articles credit David Ricardo's 1817 book with explaining this law of comparative advantage. Murray Rothbard points out that other people were saying it before Ricardo, but it's a trivial matter, I think. Mises thinks this is a very important issue. He calls it the law of comparative cost. After spending 145 pages laying out the categories of action, Mises, 20 pages later, early in human action, explains this law of comparative advantage. And I don't have time to fully explain this because it's actually rather complicated. Again, it's not like the law of demand. Gottfried Haberler spends 20 pages at least just sorting through the issues here on the law of comparative advantage. But basically, and there are various versions of the law of comparative advantage. There's various neoclassical versions of it, and there's various other schools of thought. And they don't all explain it quite the same way, but there is some commonalities. Basically, there's 2 ways to use a country's resources to acquire goods. You can either produce the goods domestically, in which case the cost is the opportunity cost of production, as Dr. Rittenauer clearly explained yesterday. And then the other way to use domestic resources to acquire goods is to produce the goods domestically, export the goods, and import other products, in which case the cost is the terms of trade. The terms of trade is how much you have to export to get a unit of the imported good. And then according to this explanation, with free trade, entrepreneurs will tend to specialize in exporting goods where we have a comparative advantage. And then we will tend to import goods where the terms of trade are less than the domestic opportunity cost, in which case you're acquiring goods at a lower cost, so you're using your resources more efficiently because you're trading with other countries. And because you're using your resources more efficiently, you can now consume more goods. Your consumption is greater than any possible level of production that you could have without trade. So the initial argument is that trade is better than no trade. And then you can extend this argument to say, well, protection reduces the trade, so it reduces these gains from trade. So this is many free traders rely on this argument. But this does not answer all the questions. This does not counter all of the arguments for protection. Although it's a very strong argument, Mises emphasizes this argument. All right, let's consider some of the more common arguments, and these are the arguments that I think you can use the law of comparative advantage to refute. And the common arguments tend to be the ones we hear the most are the weakest arguments for protection. We tend not to hear the good arguments for protection. So people making the case for tariffs tend to say things that are easily refuted. And one of the basic arguments we keep hearing is that tariff and other protectionist policies will create jobs, will increase employment. they'll say, look, if we protect the steel industry, look at all the jobs we've created in the steel industry. And it does create jobs in the steel industry. But the counter argument is that those jobs come from somewhere else. So within the law of comparative advantage, they're assuming that labor market's clear. They're assuming if you create jobs in one industry that you lose jobs in another industry. So if you create jobs in an industry where you don't have a comparative advantage, you're going to lose jobs in an industry where you do have a comparative advantage. And even Paul Krugman admits he'll buy into this. So in one of my articles, I think I call Krugman a cautious free trader, the pre-2000 Krugman. And he says constant employment is a reasonable approximation. So he thinks this is a silly argument. Of course, there's some things Paul Krugman agrees with us on. He thinks this is a silly argument for protection. And then the other argument we hear a lot is also really an argument about labor markets, if we think about it. And that's that there's a series of arguments that say we need to protect ourselves from low-priced imports. So sometimes, some people say this is the cheap foreign labor argument, that the idea is that if we're going to trade with countries that have low-priced labor, that our workers are going to need to accept low wages in order to be competitive with those workers overseas. So we need to protect ourselves. They're going to sell us low-priced products, and it'll harm our workers, and the only way we could compete is with lower wages. The similar argument, really it's the same argument, is that we need to protect ourselves from other countries dumping products on our economy, which basically means they're selling us products at prices that are lower than our government approves of. It's a very vague dumping. There's about 3,000 charges a year where the federal government charges foreigners with dumping products on our markets. It's just this vague low price. It just means they're selling us products at low prices. But of course, we can use the law of comparative advantage. Lower prices for imports means we have better terms of trade. It means we don't have to export as much. We get to import more, and we get to have more stuff. We get to have more goods and services because they sell us stuff at low prices. The best thing that could possibly happen would be if others just gave us free stuff, free cars and clothes and food. This would be, if aliens would just appear and shower us with cars and clothes and food, we wouldn't have to work very much or at all. This would be the best possible world, the best possible terms of trade. We could keep everything we produce, plus we get to keep everything they produce, right? This would be wonderful. So this, again, is not a very strong argument for tariffs. Another argument that historically people have thought has been a slightly better argument than these first two is this infant industries argument that you may well have heard of. It goes back, well over 2 centuries. The argument, at some level, some versions of this argument agree with the law of comparative advantage. They say we get to reap the benefits of trade by having free trade, but we have to wait until the industries are mature. We need to protect the industries during their infancy period, and once they're big, strong, competitive industries, we can have free trade, and the law of comparative advantage kicks in at that point, and we can reap these gains from trade. There's a lot of things wrong, I think, with this argument, but I think Rothbard really points out the main thing. So the main issue is we don't want some industries to be born. Some industries, over the life of the industry, would be a waste of resources. We only want certain industries to be born and go through its infancy period and mature and be competitive. And we should expect private investors to fund the right industries. We should expect private investors to notice the industries that are profitable over their lifetime and to fund them during their infancy period, and then there'll be strong competitive industries. I mean, private investors all the time lose money for a while and then they make money later on. This is not a new thing. So Rothbard, cogently points this out. He says, in fact, if long-run prospects in the new industry are so promising, why does not private enterprise, ever on the lookout for a profitable investment opportunity, enter the new field? Only because entrepreneurs realize that such investments would be uneconomic. It would waste capital, land, and labor that could otherwise be invested to satisfy more urgent desires of the consumers. So the only way this argument makes sense is if you think government officials can spot the right industries better than private investors. So if you think that, if you think private investors have animal spirits and are basically irrational, and there's some government officials that know which industries to protect, that's the only way you can start to counter Rothbard's argument here. All right, these are very easy arguments to contradict. In these arguments, we should note that I'm assuming that the capital for these industries, these different industries, is coming from a domestic source. So they're reallocating capital, if they're funding the infant industry, away from another domestic industry. The capital is not coming from foreign investment. Sometimes these two arguments get confused, the infant industries argument and the argument about foreign investment. So it's important to separate these two points. But these arguments are silly arguments. I'm going to go back to Krugman here. Krugman talks about these arguments, and he says, I'm convinced that many economists, when they try to argue in favor of free trade, make the mistake of overestimating both their opponents and their audience. It is remarkably easy to make fools of your opponents, catching them in elementary errors of logic and fact. This is playing dirty, and I advocate it strongly. So it's easy to crush these simplistic arguments for tariffs. All right. But this law of comparative advantage has a lot of underlying economic analyses to it about labor markets and entrepreneurial decision-making, and it has a lot of premises to this argument. And if these premises are not correct, then we can't base our free trade arguments on this law. We can't always use the law of comparative advantage to counter pro-tariff arguments. This is similar to, say, non-Euclidean geometry. So once you say you object to Euclid's controversial postulate about parallel lines, then the rest of the Euclidean edifice kind of collapses, right? You can't rely on his proofs anymore. So it's a similar idea here for thinking about the case for free trade. So what are some of these premises? Well, one of the premises is that the tariff does not affect the terms of trade. So when we explain the damage of protection using the law of comparative advantage, we always assume that the protection, that we have the same terms of trade with and without the tariff. Or that's the general argument here, at least. But as early as the 1840s and probably the 1820s, people were pointing out that that might not be the case. And this is the basis of the optimal tariff argument. So if a tariff on steel lowers the world price of steel, then this will improve the U.S. terms of trade. And if the benefits of the improved terms of trade exceed any damage done by the tariff, then wouldn't it be better to have the tariff rather than not have the tariff? Wouldn't the net benefits of the tariff be positive? That's the basic argument in very brief form. And we can't, again, the law of comparative advantage just assumes this away. It doesn't directly counter this argument. I'll give you a framework for countering these arguments after I talk about these premises. Another issue that goes back, I don't know, a century or so, as soon as they started talking about externalities, implicitly, when we talk about the law of comparative advantage, we're assuming that there's no positive externalities. So this literature has arisen in the neoclassical world saying, what if there are externalities? And generally they're talking about research and development. They're talking about the benefits of having industries within our country that engage in research and development, and maybe that research and development helps other industries in the country. So briefly, the argument is, could the government target the right industries? Shouldn't the government impose tariffs on industries and protect industries that would allow them to locate here, and those industries would engage in research and development? That research and development would diffuse throughout the economy and help other industries, generating these positive externalities. And if the benefits of the externalities exceed any damage of the tariff, then the tariff has generated net benefits to our economy. In brief, that's the argument. And then there's a newer argument. It's not new, but it's newer. Within the law of comparative advantage, we're assuming that prices and costs are correlated. So you'll see time and time again, people explain the law of comparative advantage, and they'll say the cost in this industry is twice the cost in that industry, therefore the price in this industry will be twice the price in that industry. There'll be a strict one-to-one correlation between costs and prices. So in the neoclassical world, we call this purely competitive markets. Markets are purely competitive. But what if they're not? Well, if they're not, then all sorts of things happen. There's just all sorts of arguments for tariffs. Paul Krugman won his Nobel Prize largely for his work in this area. Not that we approve of that, but so I'll give you one. This is a very complicated issue. I'll give you one example. Suppose there's a firm that is going to make it has a lot of market power, and it's going to make tremendous profits, and it's going to sell to people around the globe. So wouldn't it be best to have that firm located in our country? And that way, the firm's located in our country. They're not using many of our resources because their price is a lot higher than their costs, and they're generating all of this revenue by selling to people in Europe and Asia. And these rents from having these firms with this tremendous market power, these additional benefits to these rents may exceed the damage of a tariff. Again, wouldn't a tariff generate net benefits in such a situation? All right, these are all well-known arguments for protection. But I think the argument that we hear a lot from politicians is a different argument. So I'm going to focus on that argument in particular. So another very important explicit premise of the law of comparative advantage is that capital is immobile across political borders. So the idea is the factors of production are completely mobile within the country, but they tend to not cross political borders. So capital does not move from the U.S. to China or from Europe to the U.S. It's a critical explicit premise in Ricardo. It's an explicit premise in Mises's work in this area. Mises multiple times says, Ricardo, here's one of his quotes. He says, Ricardo deals with a world whose conditions are determined by settlement in earlier days, a world in which capital goods and labor are bound to the soil by definite institutions. Here, the law of comparative cost comes into operation. At times, Mises has said law of comparative advantage, and sometimes he says law of comparative cost. And then 10 pages earlier in Human Action, he basically said the same thing. In his 1943 article, Autarky and its Consequences, he makes a similar statement. He drives this point home. He's writing this in the 1940s. He's saying in the 1940s, capital is essentially immobile. There's not a lot of international, there's not a lot of foreign investment. So he's saying we can rely on the law of comparative advantage here. And we'll go to, we'll have further proof here. We'll go to the to the master. Joe Salerno says, the Ricardian theory of comparative advantage does only apply under the assumption of absolutely rigid factor immobility between countries. This is not a controversial statement. All right, so if we're going to give Presidents Trump and Obama and Bush any credit for their arguments for tariffs, we might say this is their argument if we read between the lines a bit. Isn't this really what they're talking about? Sometimes it's sort of explicit. So they're saying tariffs will tend to increase net capital flows into the U.S. I think this is what they're saying. They tend to ignore any negative effects of tariffs and only look at the positive effects of the capital flows. But nonetheless, I think this is, if we want to give them a sympathetic reading, this might be their argument. All right, this is not a new argument. Gottfried Habeler, in his international trade book that you could read at Mises.org, it's available online. The English version came out in 1935. It was translated in 1935. And he cites multiple authors making this case for tariffs before 1930. This is an old argument. So the first step in the argument is, can the tariff increase net capital flows? So net capital flows are capital inflows minus capital outflows. So more net capital flows means there's either less capital flowing out of the country, or there's more capital flowing into the country. And Habeler goes through historical examples, and he says the facts on which this argument is based are not open to question. Thousands of cases bear witness that the imposition or raising of tariffs may lead to an import of capital. Habeler, he's in favor of free trade. He's just saying, yes, a tariff may increase investment in the protected industry. He's not talking about the economy overall there. He's saying, if we protect the steel industry, there'll tend to be foreign investment in the steel industry. And then the second step in the argument is that these capital flows benefit us economically. So in the government's measure of capital flows, they include things like China loaning money to the U.S. government. That's not the type of capital flows Mises is talking about. He's talking about foreign investment in the private sector in our economy. And he spends several pages in Human Action explaining the historical situation here. And then he says, it was European capital that accelerated considerably the marvelous economic evolution of the United States and the British dominions. Thanks to foreign capital, the countries of Latin America and Asia are today equipped with facilities for production and transportation, which they would have had to forego for a very long time if they had not received this aid. Real wages and farm yields are higher today in those areas than they would have been in the absence of foreign capital. We probably all agree this is more capital is better. More private capital is better for our economy. And then Mises has a wonderful short article called The Plight of Underdeveloped Nations. And he says much the same thing. He says they're underdeveloped because they have been slow in developing those ideological and institutional conditions, which are the indispensable prerequisite of large-scale capital accumulation. And he says, what should these nations do to eradicate penury? They must resort to laissez-faire. They must remove all obstacles, fettering the spirit of enterprise and stunting domestic capital accumulation and the inflow of capital abroad. So these underdeveloped nations don't save enough money to develop their own capital, so he's making the case here that they should have institutions that attract foreign capital. He's not making the case for tariffs. He's making the case that they should have other institutions that attract capital flows into their countries. So it's a very straightforward argument once we see these two steps. So we've seen that a tariff could possibly lead to net capital flows into the country, and that there would be benefits if that occurred. So the point here, and the reason you can't use the law of comparative advantage here, is that in the law of comparative advantage, if you produce more of one product, the opportunity cost falls on your country, right, on your economy. But here, the opportunity cost is borne by the other, to some degree, by the other country. So if we protect our car industry and Toyota builds cars here, the opportunity cost is that they didn't build cars somewhere else. So this is why they argue maybe tariffs are good, due to these, the possibility of attracting foreign capital. And then the conclusion would be, if there were benefits of this increased capital stock, or there are benefits, the tariff generates increased capital accumulation with the resulting benefits. If the resulting benefits outweigh any inefficiencies due to the tariff leading to an inefficient allocation of resources, then there are net benefits to the tariff. This is the pro-tariff argument that I think is on the table here. All right, so how should we respond to this argument? There's a lot of responses, I think, but, and I can't even cover them all. There are free traders out there that are basically free trade in every situation. They say they've looked at the data, and it tells us that in all of these cases, historically, free trade has been, the tariffs have done harm, right? Even if there's capital flows or optimal tariffs or all these arguments, there are pro-free trade economists that say that these are theoretically valid arguments, but empirically they're wrong. But we can't empirically test proposed, what are we going to do with proposed tariffs? I mean, we can't test Trump's proposed steel tariff and aluminum tariffs. Well, all we can do is say what happened in the 1800s, right? So there was no Trump tariffs in the 1800s. So that we can't really refute the upcoming tariffs using this type of argument, I think. So I think the Misesians have a theoretical response to these arguments. All right, let me talk about some of the free trade arguments, and then I'll get to what I think is the heart of the matter. So when we see these arguments for tariffs, most of these arguments are in the neoclassical world. They assume away any public choice problems. They assume the government's going to attempt to enact policies that help out society. They assume government officials are not trying to acquire and hold on to political power. Even Paul Krugman admits this is nonsense. He says he's talking about the tariff in particular. He says governments do not necessarily act in the national interest, especially when making detailed microeconomic interventions. Instead, they are influenced by interest group pressures. Another argument for free trade is that in the arguments I just laid out, I was sort of assuming away any possibility that foreign governments retaliated in any manner. But of course, they're going to generally retaliate to US tariffs. In the neoclassical world, when they build the pro-tariff models, they usually use the phrase that foreign governments are passive, which means that foreign governments just do not react at all to US policies, right? But the arguments kind of crumble once the foreign government starts to try to attract capital flows or improve their terms of trade. Another argument that I don't think gets emphasis, another argument for free trade regarding capital flows, is that there's a lot of things that attract capital. The tariff is not, I don't even think the tariff is the main thing. The main thing that attracts capital is just the general business conditions and the institutional structure within that country. Does the institutional structure allow investors to reap their profits? And this is not a discussion-ending argument, but it seems to me that we could make the case that governments that have free trade policies would also tend to have other policies that would attract capital. government, they would tend to be less interventionist overall, and these are the types of economies I would expect foreign investors to want to invest in. But we see the general condition of the economy is a critical issue. When after the 08-09 economic collapse, foreign investment collapsed in our economy. Foreign investors did not want to, the trade deficit fell 50% because foreign investment collapsed in our economy, because general business conditions have more to do with the foreign investment than a tariff. But I don't think this is the overwhelming case for free trade. I think there's a strong argument for free trade that refutes all of these more sophisticated arguments for protection. And the problem here with implementing a tariff, say to attract foreign capital, is that the effects of the tariff, especially a tariff on like steel or aluminum, the effects would just ripple throughout the economy and affect so many decisions. Ben Powell has a recent article saying that the proposed Trump tariff on steel would affect millions of decisions. And I think that's correct. It's just going to affect every entrepreneur who's using steel in making their product. So these effects are just assumed away when people say that we need to try to attract foreign capital via the use of the tariff. They just forget about the general equilibrium effects here. So if you're going to, let's assume that the government could impose a tariff that attracted more capital into the country. If you're going to attract more capital, that means you're going to have a larger trade deficit. There's a strict correlation between the size of the trade deficit and the amount of net capital flows. If there's more net capital flows, there's a bigger trade deficit. So if you're going to have a bigger trade deficit, that either means that you're importing more or you're exporting less. So suppose you're importing more. So you protect industry A, so that means you import more at industry B. That means foreigners are producing more of this industry B product. This is a profit opportunity for U.S. investors to invest overseas. So this would tend to lead to capital flowing out of the country in this other industry. The other option is that if we increase net capital flows, we have a larger trade deficit, maybe that leads to fewer U.S. exports. So if the U.S. industries are not going to export product C, that means other countries are going to produce more of product C, because we're not producing it. So that's a profit opportunity for U.S. investors to invest in product C overseas. So this increased, these capital inflows into the protected industry leads to capital outflows in other industries. It also leads to more capital inflows. And some industries expand, some industries contract. It's a very complicated set of issues here. The tariff affects a lot more than the protected industry. Another issue here is that if we protect the domestic industry, if we protect industry A, not only will foreign investors tend to invest in industry A, but domestic investors will also. So we will reallocate capital away from some other industry into industry A. We'll reallocate it from industry D to industry A. That means we're going to produce less of this industry. Oh, I've confused my letters here, haven't I? I apologize. So if we're going to produce, if domestic investors are going to invest in the protected industry, they're going to invest less in some other industry. Whatever industry that is, foreigners are going to pick up the slack and produce more of that product. So again, this is a profit opportunity for U.S. investors to invest overseas in that industry. Another example of why attracting capital in one industry leads to capital outflows in other industries. Gottfried Haberler sort of discusses this in 1935 about all these complications. And he starts the discussion by saying, even if you attract capital in one industry, you'll never increase capital overall. And then 7 pages later, he says, well, it's unlikely. So he kind of backs up and says, well, maybe you will, but it's unlikely. And so he could like imagine a world where overall capital flows increased. But there's a lot of other complications, a lot of other general equilibrium complications. So in addition to these industries expanding and contracting due to the tariff, as the tariff effects ripple throughout the economy, as industries get larger and smaller, their capital intensities tend to change. So they don't stick with the same combination of capital and labor. So this is an additional complication that the government has to understand if they want to implement these policies. And another thing that happens is that the short-run effects are different than the long-run effects. So if the government wants to try to implement this wonderful tariff to increase the amount of investment in our economy, in the short run, the elasticities tend to be less than in the long run. The government's going to have to take this into effect, into consideration. They're going to have to try to guess what are the long-run price elasticities in all of these industries. This is just an impossible situation, I think. So I think the case for free trade is analogous to this impossibility of socialism. You've heard Dr. Salerno explain this case. I don't have to drone on about it. But Mises, in talking about the impossibility of socialism, says, the theory of economic calculation shows that in the socialist community, economic calculation would be impossible, as you heard earlier today. And he goes further and says, calculation is possible only when prices for all kinds of goods and services are established in the market and furnish a basis of reckoning. Where there is no market, there is no price system. And where there is no price system, there can be no economic calculation. So it's possible to implement a society, an economy with private property, with the market prices for resources, and that would lead to economic calculation. It's impossible for the government with socialist policies to figure out this, to perform this economic calculation. Right? Isn't this a similar argument to trade? There's imposing these tariffs or other protectionist policies to attract capital or for other reasons. It's just impossible for the government to predict what's going to happen. Right? So similarly, it's not the calculation argument, but I think it's a similar argument. As Peter Klein explained, the market is a process. Entrepreneurs face risk and uncertainty. An entrepreneur is not even certain about what's the outcome of his decision, and no entrepreneur knows what the outcome is throughout the economy. It's just an impossible set of things to understand. And yet, to implement these optimal trade policies, the optimal tariff policies, to implement protectionist policies that benefit the economy, generates an impossible calculation for the government that simply can't understand all of the effects of a tariff. They can't, even if you could consider a world where the tariff attracted capital and the benefits of the capital exceeded any damage, it's impossible for the government to implement that policy. Right? Free trade is an implementable policy, just like private property and free market prices is an implementable policy. But welfare-enhancing protectionist policy is not. Right? It's impossible, I think, in the same sense. All right, that's my case, my hopefully Misesian case for free trade. Thank you. Certainly.
No problem.
What have I got here?
What were we talking on?
Protection and free trade. They're arguing with them.
Okay.
They're really just saying I left things out. Oh yeah, I got 45 minutes.
Oh yeah. Oh yeah. I took a. Oh sure, yeah. They know that. In fact, I take this minimum wage lecture. I took all the technical stuff out from the beginning and put it all the way at the end, and I don't cover it anymore.
Right. Well, they probably sort of get that.
Yeah. I mean, I talk about it very, very briefly. lot of money someday. Okay, ladies and gentlemen, please take your seats. We're about ready to begin. This is my first lecture. Couldn't wait to get going. It's on the minimum wage. And some people didn't show up here today, and because they thought they knew enough about the minimum wage. Minimum wage causes unemployment. And so they went to David Gordon's lecture downstairs. I pity them. Okay, so the minimum wage, as I mentioned on Sunday night, is a classic example of economic analysis, both for the Austrian School, even mainstream economics, and so it's pretty important, and it's an example of government intervention in the economy. So you have society as a free society with no government, and then government intervenes in the economy. It does things like regulations, price controls, which we're going to be talking about here today, taxes, subsidies, monetary policy. The list of government interventions, unfortunately, in our society is practically endless. But this is an example of where the Austrian School really is credited with developing the concept of government intervention. When Mises first started on this journey, you look at his early works, and it was about price controls, basically, and that's been expanded over time by Mises. And then in 1962, in Man, Economy, and State, or Power and Market, Rothbard put together a complete picture of the extent and the effects of government intervention. So obviously this is a topic of great interest to most people here. Some of your classes so far help develop the analysis of, in this case, price controls or minimum wage, subjective value and market price. Okay, we're talking about market prices here, very fundamental. Professor Rittenauer's lecture on the division of labor and social order. Obviously, that's going to play a role here, as well as entrepreneurship by Professor Klein. So all of that's going to be part of the package that we'll be going to talk about today. Now, in the market economy, with the absence of government intervention, you get to choose your own comparative advantage. And you choose it based on market prices. So it's not like rocket science. Market prices are your guide to things like what products you're going to buy, what type of career you're going to follow. And so that's why Austrians put a great deal of emphasis on market prices, stable market prices, not fixed market prices, nothing like that, but stable market prices where relative prices, the price of one thing versus another, gives you information about, for example, what product to buy, what automobile to buy, the difference between, an expensive luxury car and a Honda Accord, for example. And it does the same thing for you in terms of jobs. You pick your majors, you pick your career area based on anticipated revenues, wages, salaries, and benefits. So market prices are crucial to developing, understanding, discovering your comparative advantage. Minimum wages disrupt or intervene in that process at the low end of the labor market. Now, we want to have some understanding about what determines prices, and in this case, wages. Okay, and wages are a little bit more complicated, but basically, many people in the economy, in the country, in our society, believe that somehow businesses decide on wage rates and on prices of goods. They just get to unilaterally decide these things. Well, I teach at Auburn University, and if I got to decide my wage rate it would reflect my true ability and talents and would be millions of dollars a year. Now, the president and the dean and the department head over there, if they got to decide it, they would probably want to offer me as little as possible, maybe minimum wage. Okay, that's the minimum right now. And if not for the minimum wage, they could pay me $1 a semester. But of course, that's not how things work in the real world. It's the forces of supply and demand that ultimately determine prices and that determine wage rates. And in terms of wage rates for labor, what we're talking about is a factor of production. Okay, labor, capital, land are the major forms of the factors of production. Of course, there's all sorts of labor, all sorts of land, and all sorts of capital. The wage rate is, we're going to just cover the basic factors here, is imputed back from the product that it produces. So the wage rate is highly influenced by what that specific type of labor produces, the product it produces. So an easy example is that of a petroleum engineer. Okay, a petroleum engineer is responsible for finding, drilling, discovering, and ultimately developing oil into petroleum products. Okay, so the salary of petroleum engineers is in part imputed back from the consumer good market. Okay, so the price of gasoline that you pay is going to be an important factor in determining the salary of that petroleum engineer. The example that Professor Salerno gave, derived from Carl Menger's Principles of Economics, is that of a cigarette rolling machine. If everyone decided to quit smoking cigarettes and instead were vaping or chewing tobacco or whatever, or not doing it at all, then the value of a cigarette rolling machine, which might cost millions of dollars, if you bought one. But if everybody stopped smoking cigarettes, the value of that machine, which is very highly specific, would be zero, unless you could find something else to roll up in paper that might be valuable on the market. Another way of looking at this is that the wage rate is going to be determined by the marginal revenue product. That's the technical term for the influence of the market on wage rates. So the marginal revenue product is what kind of quantity have you contributed to the firm's production and what can they sell that product for? So it's both price and quantity that you add to the company that makes you valuable and creates a wage that can be paid. Okay? Now, to illuminate that concept, that technical concept, think of a call center that has 40 people answering calls from customers, either ordering products or checking on their orders or complaining about the product or whatever. Okay, taking those orders is vital for the firm in terms of production, right? But what if our 40 people answering the call center, answering the calls at the center, had to dump their own garbage pail at work and clean their own area at work? Well, in that case, they would lose like 10 minutes every day from doing that particular chore, okay? And they might lose an entire sale as a result of that, of not being able to make that last call. Well, what if the firm hires a janitor to come by and to pick up the trash and sweep the floor every night so that those 40 people didn't have to do that job themselves? Well, the marginal revenue product of the janitor, he doesn't answer the phone at all. Not one call does he answer. And yet he creates 10 minutes of extra labor for all those call takers times 40. So he creates 40 new calls just by doing that job for them. So he doesn't take any calls, but the firm answers 40 more calls
as a result of his work. So the marginal revenue product would be 40 times whatever the price that they were selling their product for. So it's a little bit of a technical question, but I think that example sort of illustrates what's going on. So that's the demand for labor. The supply of labor is based on the labor-leisure trade-off. How hard working are you, or how lazy are you, or do you have other aspirations other than work that may be productive, but you're not actually working at a job and earning a salary? So the labor-leisure trade-off is key. It's very important. If you don't work, if you're adverse to work, we're all adverse to work in some respects. We all like leisure, and so we have to decide, do we want to work overtime? Do we want to work full-time? Do we want to work part-time? Do we want to be a substitute teacher rather than a full-time teacher? And on and on. Other factors that affect the decision and wages are training. The more training you have, the higher your wage, the more risk in a job. So if you're going down in the mines, coal mines, your life is at risk, and so miners get higher pay as a result of that risk. More skill is also important. So a lot of people can be trained to be a jeweler, to make fine jewelry, but on top of that, some people are going to be more skilled than others. And so skill also raises your wage. The trustworthiness, okay, some jobs are very sensitive. You might be handling money. You may be that jeweler who took in a Rolex watch and fixed it and kept it for himself and gave the customer back a fake Rolex watch. So certain jobs, we want people to be very trustworthy, so we pay them a lot of money. So if they break that trust, we take their high-paying job away. And then some jobs are just nasty. Okay, you wouldn't want to be an embalmer, for example, who drew all the liquids out of dead people. That would not be my first choice. So the minimum wage is a government intervention into this whole complex process, and it has big effects on the market, the low end, the low-skilled labor market. And so what I'm going to cover today is the Austrian perspective on the minimum wage, as well as the mainstream economic perspective on the minimum wage. Mainstream economics thinks that the minimum wage causes unemployment, and sometimes they don't. As a matter of fact, if you look at the Wikipedia article on the minimum wage, it goes through all of these things: wages, income, poverty, equality, and so on. And they put up a story that says it increases it, and then below that, it decreases it. So they have no firm conclusions. I will say that most economists oppose the minimum wage, but they don't really have a clear, consistent story. Whereas Austrian economics says, yes, it is going to cause unemployment, and it's going to cause a lot of other things, a lot of other negative things. So there's a great confusion on the part of mainstream economists, and I think the Austrian approach provides a great deal of clarity. And this issue is in the news again. I just read that the House of Representatives is going to consider a piece of legislation to increase the minimum wage to $15 an hour across the country by 2024. So it's going to be, if passed completely, it would be implemented over a number of years. So the minimum wage is a floor on the payment of labor. So that's the minimum employers can pay workers, except for a couple of special cases. So you can pay higher, obviously, but not lower. The current rate is $7.25, so this piece of legislation would more than double the minimum wage in the United States. 31 states have higher minimum wage laws than the federal. So that's a high number. It's the highest it's ever been. I understand. And the many cities, particularly on the left coast, have even higher wages. And so cities like San Francisco, San Jose, Seattle, Portland, and so forth have higher minimum wage than state levels. And they're experiencing a lot of the negative effects of that, of course. In the Bay Area, for example, a number of mom and pop famous restaurants have closed up shop because of the minimum wage and other regulations, as well as the age of the owners themselves. This is the conventional analysis. Supply and demand, you have upward sloping supply curve as in all markets and downward sloping demand curves, and you would have an equal, it's running out of juice here. So the intersection creates an equilibrium wage. The minimum wage is set above that. It means that more people are going to enter the low-skilled job market, and employers are going to want fewer workers. So the quantity demanded goes down. And price theory is great. It's what is very often taught by both Austrians and mainstream economists. But price theory is not everything. I learned that studying prohibition is that price really is the least significant factor of the analysis of prohibition. So there's a lot of other things that can change other than price and quantity as a result of a price floor, like here in the case of minimum wage. Okay, so on the one hand, this is the way conventional mainstream economists look at things. This one economist says there's no evidence that raising the minimum wage costs jobs, at least when the starting point is as low as it is in modern America. This apparent defiance of the laws of supply and demand occurs because the market for labor isn't like the market for, say, wheat, because workers are people. Okay, so on the other side, on the right side, you have an economist who could say, quote, any Econ 101 student can tell you the answer. The higher wage reduces the quantity of labor demanded and hence leads to unemployment. Clearly, these advocates of the minimum wage law very much want to believe that the price of labor, unlike the price of gasoline or Manhattan apartments, can be set on considerations of justice, not supply and demand without unpleasant side effects. So the quote on the left comes from Paul Krugman. The quote on the right comes from Paul Krugman. It took me a while to find those two quotes, but I knew he would contradict himself. Okay, and then there's a couple famous studies on the situation in Seattle. It's kind of complex, but you'll get the punchline at the end. The University of California, Berkeley, which is very left-leaning, did a study of Seattle food service industry, where there was an $11 to $13 increase, or almost 20%. They found little or no change in wage pay and employment in full service, that is high-skilled positions in restaurants, of only a 1% difference. There was limited services or fast food, the increase was less than expected by 4%. Hours worked declined by 13%. The University of Washington study, which is more typically mainstream or more conservative, they looked at not just food service, but all industries with low-wage workers. They found reduced hours by 9%, increased wages by 3%, but the monthly pay of these individuals reduced by $125 a month. There was, however, an increase in high-skilled jobs of $19 an hour or more. And of course, part of that is you bring in high-skilled workers in order to substitute for these low-skilled workers, and you save money as a result because the high-skilled workers can work with more capital goods, more complex capital goods. They're better workers, they're more experienced workers, and so forth. The reconciliation here is that both studies say about the same thing. Increase the wage or the price, and you decrease the hours demanded by businesses, and you get a reduction in monthly pay. So while there's a benefit in your wage rate going up, you find yourself having fewer hours, and as a result, your paychecks are smaller, not larger, on average. Both studies find a relative substitution of high-skilled workers for low-skilled workers, as we would expect. And so businesses bring in high-skilled workers and equipment in order to substitute for the higher wage rate required for the low-skilled workers. And so we're starting to see this, like in McDonald's, they're substituting kiosks for actual people working in them. And of course, they've always been doing this, making French fry machines that cooked perfect French fries, that hamburgers that cook themselves, and so forth. So the Austrian perspective on the minimum wage law is that it causes some combination of the following things. First, it's unemployment. Generally, there's some agreement there with mainstream economists. Two economists, well, I'll get back to that. So you get fewer hours, fewer jobs, fewer employers. Okay, a lot of this can actually drive people out of business. A decrease in job benefits. This is where the mainstream economists fall apart because benefits are subjective. They're very often not detailed. Companies don't have that data. And what a mainstream economist can't measure, they ignore. But job benefits are very important. Health insurance, vacation and sick leave, clean uniforms, and many other things. And also it decreases job desirability. So these are the other things other than price that are affected by the minimum wage, but because they can't be counted and measured very effectively, they're ignored. But you see a higher minimum wage and the job becomes less desirable other than wage. So the employer might make you work harder. Instead of a 4-hour shift, they may give you a 3-hour shift so that you're working the lunch hour or the dinner hour only, and there's no downtime. There's more customers than you can handle. Less sanitary conditions, like for example, well, we'll just have to fire the janitor. Less lighting and air conditioning, and the list of these things can go on and on. There's an increased demand for high-skilled labor, and jobs are automated, as I mentioned before. Now, one of the reasons why Austrians have clarity here, we can tell you exactly what the picture in general is going to be, and why the mainstream economists find conflicting statistical results, is that we stick with the ceteris paribus condition. So when we make a statement about what the minimum wage would do, we're making it under conditions of ceteris paribus, and that all other things remain the same. We know that all other things are not going to remain the same, and that would explains some of the anomalies found by the mainstream. David Newmark, for example, looked at 100 studies on the minimum wage, and even though he found 67 of them to show that the minimum wage caused unemployment, that's over 30 that did not show that. Well, what the problem is that if you increase the minimum wage and then it goes into effect 9 months later, conditions can change. The economy can go into a recession so that the unemployment as a result of minimum wage would be much greater, or the economy could go into a bubble. And so everybody's looking for workers, the minimum wage might not cause any unemployment. As a matter of fact, if you looked at the unemployment rate, it may actually go down if the change is significant enough. So two economists, pretty famous economists, Card and Kruger, came out with a study based on a 1994 increase in the minimum wage in New Jersey. And they looked at New Jersey and next door in Pennsylvania. And what they found was that the increase in the minimum wage did not result in any unemployment in New Jersey as a result. Okay, but again, things can change. And in this case, they didn't change, but a better economist named David Newmark looked at the actual tax payments by fast food restaurants in New Jersey rather than just calling up the businesses and asking them, have you fired anybody as a result of the increase in the minimum wage? Well, if you're just an owner or manager on the phone, you're going to say no. Or some of them might say, we hired more. But if you're looking at income tax receipts from these places, you've got better data as a result. So Card and Kruger basically fudged the result by using surveys, which generally speaking shouldn't be done, because survey information is just your opinion at the time. It's not a hard, cold economic fact, like unfortunately income taxes are. Another thing that we find with higher minimum wage is discrimination, okay? The minimum wage opens up opportunities that wouldn't exist in an open and free market for discrimination. Specifically, discrimination against minorities and the inexperienced, or young people without any job experience. Those areas, low-skilled labor, is where you're going to see that discrimination likely to emanate from. Okay, so looking at the unemployment rate in the second quarter of 2017, you could look at any quarter and you'd see the same pattern that results. The total unemployment rate was 4.2%, which is about where it is right now. Unemployment for 16 and 17-year-olds the total was 16.4%. So 4 times the overall unemployment rate. White teenagers ages 16, 17, the unemployment rate was 14.7%. Black teenagers 16 and 17 years old, the unemployment rate was 27.8%. And for Hispanics, it was 19%. So you see clearly that young people are discriminated against as a result of the minimum wage, and minorities are even greater discrimination against them as a result. Now, these numbers are going to be affected by other factors, but the fact that they look like this, and they always look like this, going back to the time before the minimum wage, when basically there was a free market, and in a free market there is no unemployment. If you can hire yourself out for a very low wage, you're going to get a job, okay? So this has been the pattern since the 1930s. In this study, it looks at European countries from 2004 to 2012. The blue line are countries that have no minimum wage at all. And the red line are the countries that have a minimum wage. And those countries have different minimum wages, but they have one that's effective, and it causes a higher amount of unemployment. So the blue line is countries without minimum wage, and here's countries, the red line, with the minimum wage. So it's pretty clear statistically that that unemployment issue is definitely a problem. I mean, in a place, any place, you would think they would want to maximize employment, minimize unemployment, But this is an issue that's been around for a very long time, and it's obviously hurting people. The fact that teenagers in particular are negatively affected is very problematic, because getting a job when you're 16, 17 is very important for just learning the basics about showing up and, following the rules and paying attention to your superiors, treating your other coworkers in a reasonable way or in a reasonable fashion, treating customers in a reasonable, if not deferential fashion. All of those things are very important to learn, and future employers are going to want to see that as well. So again, very important, very disruptive to the whole employment process. So minority teenagers, for example, are very adversely affected by this, and then they end up having trouble later in life in terms of developing a career and keeping jobs. Very, very important. Okay, so this graph looks at teen employment, not unemployment, but employment, and the last hike, which was in 2009. Okay, so this is an index number of teen employment. So normal would be 100, abnormally high would be 110, abnormally low would be, say, 90. This law was passed in October of 2007, I believe. So it was passed, but it was not implemented until way over here in August of 2009. So employers knew about this coming increase in their cost of production. And so what happened was, you have a normality here, and you also have the negative influence of the financial crisis. But basically, things are normal way into 2008. They're cutting back, but it's still normal conditions in the teen, low-skilled labor market. And then this is the last month that an employer could pay $6.55. After that, the minimum wage increased to $7.20. And so employers were, working, reworking their structure of production, buying more capital and high-skilled labor and getting rid of low-skilled labor. And then when you get over here to the final month, there's an 8% drop. So 8% of all teenagers basically lost their job in 2 months' time. So again, it's pretty clear evidence of the unemployment effect. So conclusions. Wage rates are determined by market factors. We discussed, the leisure labor trade-off. We discussed the compensating differentials. We discussed marginal revenue product. All of those go into the complex mix of what a wage is going to be for a particular type of labor in a particular area. Okay, so wages in general are much lower in Alabama than, say, for example, in New York City. So the same franchise would be paying much higher price for workers in New York City than they would in Alabama. So if that $15 an hour minimum wage is passed, it's going to really hurt not just teenagers, it's going to hurt the entire Alabama economy as a result. So market factors. There is no unemployment in a pure market economy. If there's no impediments to you getting a job, then there's no reason why you can't bid yourself lower in order to secure a job in the marketplace. And remember, everybody's earning their marginal revenue product, so it would be fairly easy to find work out there. In other words, there's plenty of work out there at the right wage. Plenty of work. It's just that there are restrictions on workers. So things like plumbers and electricians, you have to have a license in order to work in that area. And So that prevents you from doing small plumbing jobs or small, easy electrical jobs that you are competent to do. So it's not just the minimum wage that restricts our ability to sell our labor, but there are all sorts of government interventions that protect certain jobs for certain people and keep other people from getting into those professions, which would come after your experience as a teenager in a low-skilled job. We didn't cover this, but wage rates, increases in wage rates are driven by increases in capital. Okay, so capitalism, even though it has a bad name, it's all about capital, and capital is about technology. So if you have more capital and people can invest in better technologies, that's going to end up increasing wage rates and skill rates in the economy, because high-skilled workers using technological tools can produce more product. And if you can produce more product, it's going to result in higher wages. Of course, we also want to see the extension and expansion of the structure of production, so that the complexity that we've talked about there with the structure of production is a main driving force. The savings, the capital, the technology is just a component of the evolution of that structure of production. Early job experience improves lifetime employment and earnings. Believe me, I worked as a teenager as a dishwasher in a hospital food facility. So you would not believe the mountains of garbage and filth that I had to deal with every day. And it was one of the reasons why I decided, I'm going to get an education and be a professor. Well, once I got into college, I said, that's the kind of job I want. 4 classes, is that it? How much money? And that's, again, that's what teenagers need to experience. And it's something, unfortunately, it's not just the minimum wage, but other factors in modern American society that are preventing many more teenagers from not even being in the job market at all. And also, one of the most important points to take away, and this is something that's not unique to the Austrian School, but the Chicago School, the UCLA School, is that minimum wage laws hurt precisely those people that are supposedly intended to benefit from increases in the minimum wage. Okay, it doesn't benefit the people who need those jobs the most and would be willing to work for a low wage. Like in the 1970s, for example, going through the stagflation and high unemployment rate of the 1970s and early 1980s, a lot of homemakers, mothers, entered the workforce in minimum wage jobs to keep their family standard of living up, going through that inflationary period and high unemployment. And what that did, though, is it kicked minority teenagers out of the market as a result. So it didn't help the people who need it the most: teenagers, minorities, the disabled, the handicapped. It helped middle-class housewives supplement their household budget. So it hurt precisely those that it supposedly intended to help. Thank you very much. I've got like 40 extra slides if you guys want to come back later tonight. Do you have any questions? Yes, sir.
So one of the examples you brought up were European countries with minimum wage laws, but there's a tendency in those countries to unionize. So the countries without minimum wage, they have a tendency to have like strong unions and things like that. So how do you?
Well, I think the countries that have minimum wages are the ones that have the unions, like France and Italy and places like that. And the minimum wage is something that's pushed by unions, not because they're interested in helping low-income people, but because every time they increase the minimum wage, there's a greater demand for unionized workers. So the places where they don't have minimum wages are like in Eastern Europe. They weren't captured, I mean, they didn't have them in the communist era, and they knew that they needed to have free markets in labor in order to jumpstart their economies in the new free market era. So I think it's pretty much the case that minimum wage law countries are also highly unionized, and lower income Eastern European countries don't have the minimum wage and are not highly unionized. All the way in the back.
In the Howden for your study, I mean, you alluded to it, you didn't specify what the tax document said.
What the what?
What, looking at tax payments said, I'm assuming it said that they pay less for.
The Newmark study found that the increase in minimum wages in New Jersey did result in more unemployment. He's one of the relatively good guys in mainstream economics, serious with his statistics, sticking with economic theory. I mean, there are good mainstream economists, at least on a lot of issues. Walter Block is always famously saying that he wrote his dissertation on rent control, which is also a price control. And he brought his statistical results to his dissertation advisor, Gary Becker, a Nobel Prize winning economist, and he said, Professor Becker, rent control actually improved the situation. And Becker said, you got it wrong, Block, just go redo your statistics. So some of the good ones don't really believe in some of the nonsense that others do, and they believe more strongly in economic theory and the ceteris paribus assumption.
The unemployment rate, particularly for young people, would be much worse if it weren't for like FAFSA, which subsidized kids to go to school.
Yeah, would the teenage unemployment rate, isn't that made worse by other interventions in the economy? And I think that's absolutely true. I would say that in addition to getting rid of the minimum wage, I would also eliminate compulsory public education. And I mean, I would do it in a sensible way, at least initially, where to sell it, I would say, if a kid can pass a competency test, then he should be allowed to go to work, to take a job and to earn money. A lot of people who are in poverty would be a lot better off if they could, get those jobs and have 2 or 3 people in the household bringing in incomes. The biggest area of poverty is the fact that so many households have only one income earner or no income earners. So that would be important, yes. Yes, sir.
I saw on one of your slides previously, it was speaking about increasing wages by reducing these costs there and everything else. I'm assuming not necessarily in real numbers, but also it could just be a deflation in prices overall, even if your wages stay the same.
Yes, I mean, you have to take that ceteris paribus condition seriously. In some of these studies they do, but there are a lot of factors going on, and prices are the key thing. That's what I started out with, and that's what it's not just price theory, but you start with price theory, and then you look at these other things like how good is the job, how pleasant is the job. You look at discrimination. You look at a lot of other factors that come out of this, but you do start with price theory. Okay, thank you very much. Sure. Yes. Okay, great. I'm going to try to do a little bit of this too. At Ilin, yep. I never thought I'd be signing books. Great, fantastic. You're welcome. Yeah. No. They're used for like psychotherapy.
Yeah, so like to keep it as short as possible, Johns Hopkins University was leading the research in finding that psilocybin, psilocybin is psychoactively ingredient. They're finding that it has tremendous impact on the big three psychological disorders: anxiety, depression, addiction.
Yeah.
Like 70% long-term quit rate of cigarettes, treatment-resistant depression, treatment-resistant PTSD.
Yeah. And ecstasy is used in that way too.
Or yeah, the ecstasy is PTSD, MDMA, and both MDMA and psilocybin are designated as breakthrough drugs by the FDA, breakthrough medications.
And this is why the pharmacy companies are spending money to stop these movements.
Yeah, well, it's one, what I'm not seeing, the angle that I'm not seeing out of these movements is called Democrats is, so because they hit on those big three, let's say that's at 10% of the market that's otherwise going to doctors, just going to get the prescriptions down. If you are you're basically talking about a new field, specialized labor, psychedelic therapy, and whereas a doctor might see 10 people that they can write 50 people that they can write prescriptions in a day, sure scripts like 4 to 6 hours. So you're probably seeing 1 to 8 patients a day after you do your preliminary.
Interesting. Yeah, please come.
Yeah.
Well, you're trying to hide who you are?
What?
You're trying to hide who you are?
I'm from Colombia.
Okay.
So, by the way, I was going to talk about the phenomenon I've seen in my country. I'm a law student, and I've thought that the artificially higher wages of lawyers because of their licenses
Yeah.
has created this incentive of just to hire interns, because they can hire them for only 1 year and not for just minimum wage, while normal wage for that same position will cost like twice as much.
At least, yeah. Yeah, that, the bar exam in the United States kept women out of the legal profession for a century. Women started going to law school in the second half of the 19th century. If they could sneak their way in, they often had to sneak their way in, but they couldn't get a job except working as a legal assistant or writing contracts and things like that. They couldn't get in until about 50 years ago. Now, of course, they're set to dominate the legal profession. So the bar exam barred people, specifically women, from getting into a much higher paid job. Of course, you really needed birth control to a certain extent. But the combination of legal changes and birth control has seen the floodgates of women into the American legal profession. Yeah.
Well, Peter Klein suggested that we should ask this question on Sunny, and maybe in some industry, let's say,
Yeah, well, if the company tries to create a monopoly, labor can simply move away. Except
If I could get everybody to take a seat, please, we'll start the next lecture. I had introduced my lecture yesterday on banking with a bit of an oddity, and the oddity was, if everybody remembers, that to talk about banks is a little bit strange because we don't talk about other businesses, we don't really talk about other industries in economics, but then we center out banks. And the reason why we have lectures devoted and studies directly devoted to banking is that banks control the money supply, at least partially. Private banks through their control of the deposits, and central banks through their control of currency and reserves. And money, since it permeates through the economy, has very systematic effects. And so the banking system is very important to understand in order to understand the supply of money, and money is important to understand so that you can understand systematic effects on the general economy. Austrian business cycle theory is a theory that deals with one of those systematic effects in particular. And so just to begin, I want to define a business cycle in fairly general terms. And Murray Rothbard in America's Great Depression, he refers to clusters of errors. And he asks the question, why is it that under normal times, of course, some entrepreneurs, some business people make mistakes. You see some businesses earning losses or going out of business, having bankruptcy. But then periodically, you seem to have surges where all businesses seem to suffer at the exact same time. And it's a little bit of an oddity, right? Because we understand, since we don't have perfect foresight, that companies and businesses and entrepreneurs will make errors. Of course, if we had perfect foresight about the future, we wouldn't have to worry about this. But then every so often, there seem to be periods of time, like recessions or crises or busts, whatever you want to call them, where everybody seems to make mistakes at the exact same time, or everybody's mistakes become apparent at the exact same time. And so when we speak about the business cycle, really what we're referring to are clusters of errors. And we're trying to find one reason why it is that all entrepreneurs are making errors at the exact same time. Now, in answering that question, of course, you could look at different factors and try to find the link that connects everybody together. But the obvious one should be money, because money is the medium of exchange. It's 1/2 of every exchange that takes place has got money on one side of it. And so changes to the money supply are one of the few goods that has the possibility to have systematic or far-reaching effects throughout the whole economy. So as subsidiary questions, we could ask, what do these clusters of errors actually signify? When you have a period of time or you see a scenario where everybody's making errors at the same time, what does that actually mean? And that's what we refer to as the bust phase of the business cycle, or even the business cycle in general. And then also we can add to that, what's the common link between these clusters of errors? What is the process through which these error cycles seem to repeat themselves over and over? And then, of course, how could we stop or avoid those clusters of errors from happening again? Now, if you've taken an economics class before, or if you're an economics student, you'll see something which is a little bit strange about Austrian economics. Actually, we're the normal ones, and other economics is a little bit strange. And that is, you will start your studies in normal mainstream economics taking principles of microeconomics, principles of macroeconomics. You'll move up to intermediate microeconomics, intermediate macroeconomics. There's always this distinction between micro and macro, and there's not this same distinction in Austrian economics. I take it quite personally because students come to me and they ask quite frequently, is it necessary for me to take intermediate micro before intermediate macro, some question like that. And of course, in mainstream econ, there's very little link between the two, so one doesn't hinge critically on the other. Of course, in Austrian economics, the two are integrated into a whole, so you don't have to make this clear distinction. And really what we can get at is, what's the proper level of aggregation by which we should speak about different economic phenomenon? Macroeconomics, the macro prefix suggests that we're dealing with some level of aggregation. If we're dealing with business cycles in general, of course, we're dealing with some level of aggregation. We're not talking about specific errors made by an entrepreneur or business person. We're speaking about economy-wide errors. So the level of aggregation must matter. And I just want to do a brief contrast with a couple of other business cycle theories. So first we'll start with Keynesian, since that would be the one that most people are familiar with. And of course, in Keynesian macroeconomic theory, you deal with the national income account statement, you deal with GDP and the determinants thereof, and you've got a level of aggregation which is sufficiently high that you can't see the trees for the forest, so to speak. You can't see what the individual problems are. All you know is what this broad mass aggregate of investment expenditures or consumption expenditures are doing. All you know is that income is going up or down, but you don't really know what's going on within that mass of income. So Keynes aggregates at this high level, which makes it very difficult, if not impossible, to really tease out the problems of the business cycle. And then if you wanted to look at the monetists, Friedman aggregates at an even higher level, because the monetists start with the equation of exchange. So that doesn't even deal with the specific components of GDP, like consumption or investment expenditures. It's just about GDP as a whole. So they don't fare any better than Keynesian theory does in this respect. And when we speak about aggregation, it's important not to aggregate at too high a level, because if you do so, then you're not able to see relative price adjustments. For example, during a business cycle, we know that some prices are getting out of whack or being misaligned with other prices. Housing prices are booming, stock prices are booming, but if you over-aggregate, you're not able to see these differences in relative or specific prices actually changing. And furthermore, you can't see changes in the quantities of specific goods that are being bought and sold, or the industries that are really booming or busting. And in the Austrian theory, we don't overly aggregate, and so we have what we can refer to as different orders of goods. We don't just have investment goods in general, we have different types of investment goods, different orders of investment goods, but we'll refer more to that in a couple minutes. Now, when Ludwig von Mises lays the groundwork for Austrian business cycle theory, he does it in his 1912 book, The Theory of Money and Credit. And Mises at the time is really laying a foundation for what we may refer to as a monetary theory of the business cycle. And he builds off the currency school economists of the 19th century who were trying to understand why it was that there was a new type of business cycle, a series of booms and busts that emerged in the 19th century that didn't seem to exist in previous periods of time. And if you look back in the 19th century, there was this more or less regularity to booms and busts, where every 10 years you had a boom and then a bust that followed. Another decade later, you'd have another boom peaking and a bust, so on and so forth. And the currency school economists were trying to understand why this happened. And I don't want to get too much into the currency school economists because it's a little bit of a separate discussion. But their main emphasis was on banknotes. Yesterday in my banking lecture, I referred to the fact that modern fractional reserve banks can issue deposits without having to back them fully by reserves. That's the essence of the fractional reserve bank. The currency school focused more on private banks issuing notes and not backing them fully by gold, or reserves, if you will. And this led them to understand that the overissuance of banknotes not completely backed by gold at the time led to a series of bank runs. People would realize that the banks don't have enough gold to honor all of the notes that they've issued. Periodically, people would run to the banks en masse, do withdrawal requests. The banks would run out of reserves, would run out of golds in order to honor those requests. And a banking crisis would pursue. And what the currency school economists achieved was that they more or less identified a specific type of business cycle. The downside was that they focused narrowly on the banking system. They weren't able to elaborate it to systematic economy-wide effects. It was much more limited to one specific industry, the banking industry, and some loosely associated industries as well. And Mises in the theory of money and credit is able to expand on this general idea, but to focus on the economy as a whole, not just the banking system, but that was the core of his understanding of how it is that the general economy, the real economy, was able to enter into this boom and bust phase. And in doing so, what he does is shifting the focus, not on banking crises in particular, but on intertemporal disequilibrium. And by intertemporal disequilibrium, what we're referring to is a mismatch that's happening over time between our plans, our consumption plans, and our production plans, where everything is not synchronized in a way where our plans can be successfully completed. So investors are starting production plans or projects that are not able to be completed because there's not a synchronization over time with other investors' projects or plans, and consumers are facing the exact same problem. And in trying to search for a reason of why it is that there's this intertemporal disequilibrium which has been created, Mises focuses on the role of credit creation and its effect on the interest rate. And of course, the interest rate, if you listen to Dr. Herbener's lecture this morning on the rate of interest, the interest rate is impacted by the creation of credit. A greater supply of credit increases the supply of present goods, depressing the market rate of interest. And as the market rate of interest is depressed, it also has knock-on effects disrupting or changing, at least, consumption and production plans. And so Mises uses the banking system. He springs from the currency school's focus on the banking system and the overissuance of banknotes to see the effects that this has on the rate of interest, and then uses the rate of interest to understand the effects that that will have on the economy as a whole. Now, before I go further into describing more thoroughly what an Austrian business cycle theory is, I want to lay out what it's not. Because over the last couple of years, and especially since the crisis, there's been a real revival in interest amongst some mainstream economists to Austrian business cycle theory. Good thing. The unfortunate part is it's often mischaracterized in very simplistic terms, and the most frequent way that it's mischaracterized is as an overinvestment theory. It gets described as a theory that explains why it is that there seems to be too much investment, too many people buying houses, too many entrepreneurs building factories or building cars or whatever on the eve of the boom turning to bust. And so the theory, one theory characterizes Austrian business cycle theory as too much investment, it overheats the economy, we've got too many goods, and, well, it's just got to bust, and we have to get rid of this oversupply, these excess inventories of goods. So that's one mischaracterization of Austrian business cycle theory. A related mischaracterization is that it's just naturally occurring. Like, some people believe that the economy just booms and busts and there's not much that we can really do about it, and that it's just that entrepreneurs every now and again do too much investment, and that's the way that they are. That's not especially helpful, by the way, in understanding any business cycle theory, and that's also not what Austrian business cycle theory is about at its core. And yet, another way to interpret it, or misinterpret it rather, is that entrepreneurs are led to make market failures. They're led to make mistakes, or they're prone to make mistakes, which have to get solved out by the recession, or which are exposed by the recession. And so these are ways that the Austrian business cycle theory has been characterized over the last couple of years, especially since the crisis, but it doesn't accurately describe what it is. So, when we speak of an Austrian business cycle, we need a couple of components. There's a couple of elements that you've already learned over several lectures between yesterday and today, which are necessary to describe it. So first we have to go back to Carl Menger, and Menger's focus on defining what a good is and what are the differences between different types of goods. And of course, Carl Menger was able to establish that there's not just goods in general, there's what we can refer to as different orders of goods, higher order goods and lower order goods. And a lower order good would be, well, the lowest order would be a consumption good, something that's ready for you to consume right now. And of course, that consumption good just didn't come from nowhere. It had to be made by higher order goods. These are the necessary input factors. And so one example that Rothbard uses in Man, Economy, and State is the production of a ham sandwich. And when you're finally ready to eat it, that's the lowest order good. But of course, in order to eat it, you needed to have bread and ham, and you needed a knife, and you needed input factors, and these are all higher order goods that we can talk about. And earlier today, in Professor Rittenauer's lecture on capital structure, capital theory, he also referred to different orders of goods, different orders of capital goods. You have some capital goods that are closer to final output, producing consumption goods. Then you have higher order capital goods, which are less directly related to the production of consumption goods. And then we have Bombaverk and his theories on the rate of interest, which Professor Herbener talked about in his lecture this morning. And we understand that the rate of interest is a naturally occurring phenomenon which we can represent, or we can describe as being the value spread between want satisfaction today and want satisfaction in the future. So to the extent that you value satisfaction in the present more highly than the future, we have a positive rate of interest which expresses this value differential. And then finally, we've got Mises' attention or focus to intertemporal coordination. And when Mises ties together, when he discusses intertemporal coordination, really what he's doing is weaving together the different orders of goods that Carl Menger described and the role that the rate of interest that Bombaverk has elaborated on to make it a consistent theory. And when we refer to intertemporal coordination, we refer to two things at the same time. on the one hand, we need production plans to be synchronized with consumption plans. What we produce needs to be what people are wanting to consume. And at the same time, production is not just one specific stage. Production involves many different orders of capital goods, and they all need to be synchronized with one another. You can only make your ham sandwich if somebody previously made ham. I'm not going to get into the details of that. And you can only make your ham sandwich if somebody previously made a knife. And the knife manufacturer can only make the knife if somebody previously refined metal, or so on and so forth. And so intertemporal coordination requires consumption and production plans being in sync with one another. Now, the most succinct way that you can summarize or characterize an Austrian business cycle is by its two components. The first one is what we can call overconsumption. And overconsumption is the idea that during a boom phase, people have a tendency to consume more than would otherwise be the case. And not only that, they consume more than is sustainable given savings patterns elsewhere in the economy. And so during a boom, and I will elaborate this as we give some examples later on in the lecture, we should be able to see that there is this overconsumption component to it. And then at the same time, and perhaps more importantly, the component in Austrian business cycle theory which is most unique is the idea of malinvestment. Now, when I, a moment ago, told you about the mischaracterization of Austrian business cycle theory and this somewhat revival that it's had in the mainstream since the crisis, I was referring to the fact that many mainstream economists construe it as being an overinvestment theory, that investors are just doing too much, and that's what needs to be cooled off later on during the recession. It is true in a way that investors are being led to take on more investments that would otherwise be the case, but that's not really the story, and it's a subsidiary story, if anything. The important thing is what we call malinvestment. It's the temporal ordering of all the investments that investors have been making. And what's necessary is that we have a consistent pattern of production plans that feed into one another so that every stage of the production process has the inputs which are necessary for the entrepreneur to complete his or her plans. And what's important is that we don't start unsustainable investment projects. We don't start plans that can't be finished or completed fully. And so this malinvestment refers to the structuring of capital, the structuring of higher order goods, not necessarily the absolute level of it. Now, if malinvestment can refer to unsustainable investment projects, it's important to understand what we mean by unsustainable. And the Austrians are very good at defining the difference between sustainable and unsustainable growth. Because we should recognize that not every boom is going to be unsustainable. Not every boom necessarily needs to lead to a bust, right? You can have secular economic growth. You can have boom phases which are there for good reasons and predicated on good, positive, sustainable factors. But not all of them are so, and to that extent we need to understand what is it that would define an unsustainable growth phase. Now, sustainable in this sense means backed by real savings. A sustainable investment is one where the resources being used in that investment process have been freed up by somebody not consuming them, or somebody else in the economy not using those resources. So the only way you can build a house is if somebody decides to not use the bricks for some other purpose, right? No, two people can't use the same bricks at the same time. The only way that you can build a ham sandwich is if somebody else decides not to use that ham, right? If they refrain from eating that ham, it's available for you to use. The same thing must hold true for money, right? The only way that you can use money in a production process in a sustainable way is if somebody else restrains themselves from spending that money. And so we define sustainable growth as growth which is built off the back of real savings. Savings here defined as not consuming. People don't consume, we accumulate savings, and then we can invest sustainably. Now that begs the question of what we refer to by unsustainable growth, and there's two forms that I'll refer to. The one form is unsustainable growth, which is built on the back of credit, which has been created by the central bank. Yesterday in my banking lecture, I referred to the primary means through which the central bank can increase the money supply, its open market operations. One means is that it can create currency and issue currency out of thin air. All it has to do is print up currency, which is not very expensive, buy bonds from banks and issue the currency into the system. And of course, entrepreneurs could use that currency to start investment projects, but it's not going to be predicated on anybody not consuming or anybody saving ahead of time. It's just going to be built on the back of the central bank's whims. Or perhaps more importantly, we can focus on the fractional reserve banking system. because the fractional reserve banking system's essence is an ability to issue loans against deposits and in effect create deposits out of thin air. And so if either of these phenomena occur, central banks issuing credit or fractional reserve banking system issuing credit, we have the ability to finance entrepreneurial ventures without anybody constraining themselves from consuming. And that's what we can define as unsustainable growth, or that's what will lead later to unsustainable growth. And one final thing before I go into the nuts and bolts of Austrian business cycle theory, I want to introduce what I call Hayek's maxim. It's a great little quote, I think. Increasingly, I think it's more and more important. In an article he wrote in 1937, Hayek writes, "Before we can meaningfully ask what might go wrong, we should first understand how things could ever go right." I like it because, of course, it makes sense. Before you start analyzing problems, you should understand why would the problem even exist in the first place? Why should things go right? And you can't just dive into a problem without first understanding how things would go right. I take it to heart because increasingly, as I teach introductory economics, I see young students coming in and they care about the problems of the world, global warming or whatever have you, and they want solutions right away, but they don't want to go through all the work to understand how things go right. They just want to dive into solving the problems. And unless you do that critical step of understanding how it is that things go right, form a consistent theory to understand how plans would actually work out, you can't very well understand why things are going wrong. So Hayek's maxim is a good dictum to have in the back of your mind. So I want to introduce Austrian business cycle theory by way of two analogies. And the two analogies are going to allow us to tease out the difference between sustainable and unsustainable economic growth. The first one is a Robinson Crusoe analogy. Robinson Crusoe washes up on a desert island. Doesn't have anything to his name, right? He doesn't even have clothes, let's assume. He washes up on the desert island, and the first thing that he does when he gets his act together is realizes he's hungry and he looks for something to eat. So luckily there's some bushes with berries on the desert island, and he starts picking off berries. The only problem with picking berries to try to stay alive is you probably have to work every waking moment of your life to get enough calories to stay alive. So Robinson Crusoe spends his whole days picking berries. It's not a very productive way to produce berries, but it gets the job done. Now, the only way he can grow economically, have economic growth, is if he becomes better at picking berries, becomes more productive at picking berries. The only problem right now is Robinson Crusoe needs to spend all of his time picking berries to stay alive, that he doesn't have much scope for that. But he thinks about things and he looks around and he notices that the top of the trees are much more densely populated by berries than the bottom branches. And if only there's a way that he could reach the top branches, he would be much more productive, right? Instead of picking all these little berries at the bottom, he could get the big ones at the top. And he thinks about it and he says, well, the easiest way I could get at the top berries is if I had a suitable branch in order to do it. The only thing is there's no suitable branch right where I am, and I need to go out and find one. But if I go out and find one, that means that I'm not able to pick berries. And if I don't pick berries, then I'm not going to be able to stay alive because I need to eat. And so Robinson Crusoe has a bit of a problem. If he wants to improve his lot, if he wants to grow economically, he needs to become more productive. If he wants to become more productive, he needs to make an investment. The investment is he needs to build a stick or find a stick. In order to find the stick, he needs to not work. But if he's not working, he doesn't have any food in order to eat. So he's going to die or go hungry or be uncomfortable. And so Robinson Crusoe comes up with a solution, and the solution is he's going to restrain his consumption. He'll set aside some berries every single day and make a stockpile. And then he's going to take a morning off picking berries, and he's going to go out with his stockpile of berries to keep himself fed, and he's going to search for a stick. So for a week, he saves a couple of berries every day, and he builds a little stockpile. And that stockpile, by the way, is savings. It's unconsumed resources. He withheld his desire to eat, got a stockpile of berries, savings, and he sets out into the wilderness. And he eats the berries along the way. He uses up his savings as he searches for a stick. And then finally, he finds that suitable stick. And he gets back just before his stock of savings runs out, so he doesn't have to go hungry. And then when he gets back there, he starts using the stick, and he reaches all the berries on the upper branches, and all of a sudden, he's much more productive, and his lot has been improved. And we can analogize this by saying he's experienced economic growth, right? He's better off than he was previously. And maybe you could extend the example. You could say, well, if you wanted to have even more economic growth, maybe he needs to have a spear to catch fish or something like that. But of course, to find a spear or to build fire, he needs to take even more time off producing berries. So he would have to set aside more berries, which, by the way, is a little bit easier now, given that he's more productive. set aside more berries, then go out on the task of building fire, finding a sphere, or producing a sphere, so on and so forth. And that's how economic growth happens. Now, in the simple analogy, there's a couple of steps that he's gone through that lead to sustainable, what we refer to as sustainable economic growth. The first step is that we can understand that savings were a prerequisite and a necessary prerequisite for the growth to happen. If Robinson Crusoe did not constrain from eating berries initially, he wouldn't have been able to sustain himself while he partook in the time-consuming production process of finding a suitable stick. So the saved berries were necessary for him to actually do the investment later on. If he wanted more growth, he would have to do more or better investments, but that would just necessitate more savings, right? He would have to save up more berries, restrain his consumption habits even further in order to free up enough berries to pursue a longer production process or a more intensive production process. And then finally, we can understand the relationship between savings and consumption. The only way Robinson Crusoe can save more is if he consumes less. He can consume more, that's fine, but if he does so, he won't have savings available. And if he doesn't have savings, he can't partake in production processes. You can summarize this by saying that growth goes right, in the sense that it's sustainable, when savings and consumption patterns are consistent. Robinson Crusoe's growth was fully consistent, fully sustainable, because his savings habits were consistent with his consumption habits. Now, that's a simple example, but we can expand on it a little bit, and we can modify it to see how things might go wrong. So Mises in Human Action introduces another simple analogy, which you can call the master builder example. And the master builder is, imagine that you have a home builder who sets out to construct a whole bunch of homes. And normally, of course, if you want to build homes, you need resources to do so. And where do those resources come from? They have to be freed up from somebody else. So somebody will have to not consume some resources or not use some resources. So the master builder has bricks and cement and shingles, et cetera, to complete the houses. But then imagine a scenario where something fools the master builder into thinking there's a greater supply of bricks available than is an actual fact. And the builder starts by building 10 houses, but there's only enough bricks for 7, let's say. And you don't know when you just start building houses, you know, they're halfway completed, you don't know, you have a big pile of bricks there, it looks sufficient to finish the job, but it only has the illusion of looking sufficient to finish the job. And so the master builder keeps building the houses a little bit higher, and eventually you would imagine you would get to a point where your pile of bricks is not looking sufficiently large to finish all these projects. And so the illusion that he had more bricks than was needed to complete these houses led him to start more investment projects, more building projects than would be sustainable. And now he's faced with a tough decision, which is, what do I do? I started 10 houses, but I only have enough bricks for 7. So he's got a couple of options. Abandon the project completely. There's better options than that. Tear down 2 of the houses. That would free up some bricks to use to complete the other uncompleted houses. But what we've got here is an example of an unsustainable investment project. He has undertaken an investment that was not backed by a sufficient amount of savings, and then it became obvious later on, or when it became obvious rather later on that the savings were insufficient, he had to change his investment plans and pursue a second best option. And from this analogy, we can tease out a couple of important facts. The first is that the mere illusion of savings can encourage investment. Or even if you lied to the master builder about how many bricks were in existence, or just skewed his expectations of how many were in existence, you can imagine he would start taking on more investments, build more houses than would otherwise be the case. And the second fact we can tease out is that the lack of resources did not enable him to finish all these projects. Unless you have enough bricks, you can't build all of the houses that you immediately set out to. And so the solution to that was that some of his investment projects had to be abandoned, salvaged the best that they could be, so you tear them down, take the bricks out, so that you can complete the other investment projects. And the lesson from Mises' master builder analogy is that growth goes wrong, or growth is unsustainable, when savings and consumption patterns are inconsistent with one another. In this story, the savings are insufficient to complete the investments. Why not? The savings would be insufficient because people's consumption habits were not reduced to a low enough state that freed up the savings for the investment. So then we try to understand, well, what's the relationship between the illusion, or what's the cause of the illusion that there's more savings available than is actually the case? And we can focus maybe most specifically on the fractional reserve banking system. Because as we went through in the lecture yesterday on banking, the fractional reserve banking system allows savings to be created, or money, I shouldn't say savings, but the illusion of savings to be created without anybody renunciating consumption. Now, the whole point to real savings is that somebody doesn't consume a good, and that frees it up for somebody else to use. But in fractional reserve banking, that's not the case at all. Somebody can make a deposit, and the bank can only hold a fraction of it on reserve and issue a loan for the remainder. And that loan, of course, gets deposited in another bank, so on and so forth. And through this whole process, we can create a supply of credit which is available for people to use, but it's not created by anybody restraining their consumption habits to begin with. And through this process, there's a couple of effects that stem from it. The first is that credit creation by the fractional reserve banking system allows for a greater quantity of investments to be undertaken than would otherwise be the fact, otherwise be true. But more importantly, we see that the decrease in the rate of interest due to the credit creation alters what we call the time structure of production. It skews the types of investments that investors are actually doing. And in particular, it favors longer dated or more distant investment projects at the expense of shorter dated investment projects. Now, at the same time, that lower rate of interest has a real effect on people's consumption habits. The real effect on people's consumption habits is that it actually motivates them to consume more. As the rate of interest falls, you would have a lower propensity to save money, and you would want to go out and start consuming more. Buy more furniture for your house, or buy new accessories for your car, or go on another vacation, so on and so forth. And so at this very time where people start taking on more investments, which would normally require a greater amount of savings, the lower rate of interest demotivates savings by the hand of consumers. And so we have a complete disconnect between the needs of the producers or the needs of the investors and the resources and the desires of consumers and their saving habits. Because it's important, and I feel very strongly about this mischaracterization of Austrian business cycle theory as a theory of overinvestment, I want to just make a brief comment about it. Because it's easy to see from what I just said that you could construe the theory as being one of overinvestment. In fact, my exact words were, the lower rate of interest induces a greater amount of investment than would otherwise be the case. But that's not where all the action is. The action is in the malinvestment, the skewing of the time structure of production. What does it even mean to say that too much investment is taking place, if you think about it? Investment is just doing something today so that you can get a payoff in the future. To say that there's too much investment going on is to say, or taking place today, is to say that there's going to be too much activity or too much wealth created in the future as a result. It's not a sensible position to have. The problem isn't that there's too much investment taking place, it's that the investment is taking place along lines or in patterns which doesn't lead itself to being sustainable, or the investments are not going to be able to be completed to fruition. The better way to characterize what's going on is to focus on malinvestment. And in particular, we will say that the structure of production has been upset by credit creation by the banking system and a lowering of the rate of interest. And when I refer to the structure of production, what I'm specifically referring to is the ordering of all of the capital goods or industries that are necessary to produce a consumer good. To give you a concrete example, the consumer good you're going to buy is a car. The car could only be produced by putting together tires and engines and metal components, et cetera, et cetera. And the tires could only be produced by somebody producing rubber, vulcanizing rubber. And the rubber could only be produced by a plantation over in Malaysia farming rubber trees, so on and so forth. So we have a structure of production where all of these steps along the way are all linked together and they're all dependent on one another. So when I say the structure of production has been upset, and that's what malinvestment is, there's two ways that I'm referring to. The first way is what you can call a derived demand effect. The derived demand effect is that the lowering of the rate of interest has caused people to want to consume more than would otherwise be the case. And of course, entrepreneurs respond to this increase in consumption habits by focusing their attention on these areas of the structure of production, those which are most closely related to the consumer goods industry. An analogy I like to use in the back of my mind is during a boom, overconsumption is more people buying furniture and cars and things like that. And entrepreneurs respond by opening up more big box stores, more retail outlets. That's at that very far end of the structure of production. And it's necessary in order to meet this derived demand that people have from their increased consumption habits. And then at the same time, there's an interest rate effect. As the interest rate falls, longer dated investments are favored over shorter dated investments. And so we see a temporal restructuring of the structure of production. A long dated investment, by the way, would be something like R&D. Pharmacy investments might take 30 years in order to break even, if they ever break even. That's a very long dated investment. Lower rates of interest stimulate those types of investment projects. A short dated investment project might be, I don't know, repaving the parking lot of your store to attract more customers, or an advertising campaign to attract more customers. And so this interest rate effect favors investment in the higher stages of production, or the earlier stages of production, those further from final consumption. And what we see is that a tug of war develops, because in the structure of production, where you have stages closest to final consumption and stages farther from final consumption, you have resources being pulled to the far stages and resources being pulled to the early stages, and not much attention paid to the middle stages. The easiest way to understand this, Hayek in Prices and Production introduces what we now call a Hayekian triangle. And a Hayekian triangle is a simple way to understand the linking between all these different stages of production. This diagram, by the way, if you're interested, is taken from Roger Garrison's book, Time and Money. It's probably the best book for a higher level understanding or look at the business cycle. And what we see on this structure of production, or this Hayekian triangle, is that on the y-axis, we have the total value of consumer goods which is being produced. Cars, vacations, food, etc. But of course, those consumer goods are only produced through this time-consuming process that links together all the different stages of production. Retail stage is the one closest to final output. You go to the store to buy the good, but the goods only got to the store through the distribution channel. That's a different stage of production. And higher up from that, the goods were only available because they were manufactured. The goods were only able to be manufactured because raw materials had been refined, and they were only refined because previously they'd been mined. And they were only mined because there was R&D in order to do so, if you wanted to add another stage on this. And so all of these stages are linked together to produce a final amount of consumer goods. And when I talked of the derived demand effect, what I was referring to was that since people are over-consuming and have increased their consumption demands, business investment moves into these late stages. This is my analogies of big box stores and bigger expenditures on retail spaces. And at the same time, the interest rate effect is motivating investors to make investments down here at the very early stages, mining and R&D in our example. And the tug of war that exists can be illustrated like this. In the early stages of the structure here, we have a boom phase which is going on. That's the malinvestment, the shifting of capital goods earlier into production. And the overconsumption phase can be illustrated in this. Capital is being reallocated into the late stages of production to meet this derived demand effect. And meanwhile, in the very middle here, the tug of war is getting tense. Resources are not being dedicated there. But of course, for the structure of production to be consistent, there needs to be a steady flow of goods that flow from the far stages to the later stages. And so this dearth of investment in the middle here is going to create problems later on. Now, before I get to the problem, I just want to focus a little bit on what the boom of an Austrian business cycle actually looks like. And so Dr. Klein, I called her Klein the Beautiful, I think, as opposed to Klein the Elder, to make the distinction yesterday. Dr. Klein talked about Cantillon effects, what we refer to as Cantillon effects, in her lecture on money. And a Cantillon effect is the recognition that, yes, when we increase the supply of money, prices are going to increase also. But the Cantillon effect is the recognition that it's not a uniform increase in prices. We can speak of it as being a wave, that money always gets injected into specific industries or specific investment projects. And that creates income for people involved in those industries. And as they spend that increase in income, that pushes up prices in those areas that they spend money on. And we can think of a wave of price inflation permeating out from the original spot where money is injected. For example, during a boom, since one of the places where you will see money injected initially into the economy is through the real estate sector. After all, fractional reserve banks issue loans primarily for mortgages. And people get their mortgages and they buy houses. So of course you see housing prices and real estate prices and land prices especially start increasing. And that increases the income of builders and people who own land who sell it. But of course, then those people turn around and spend their income. and the goods that they spend their income on. So if you're a builder, it might be on trucks, and then we'll see the price of trucks go up. And then there's people who produce trucks, and they have a higher income now, and then they turn around and they sell it. People who drive big trucks, people who produce big trucks, I don't know, like to go on vacation. And so the vacation industry starts seeing prices go up. And we'll see this wave emitting from the origin of where money was injected into the economy. And so the boom can be described as following that wave of money. And it should be no surprise, if you think about it in these terms, that when you look at a boom, the real estate sector is typically the focal point. Or big cities, where a lot of credit is injected initially, especially New York City, is a focal point in many booms. Now, when the bust comes, we can describe it in a couple different ways. The easiest way to understand why the bust actually had to happen was that we're facing a resource constraint. And entrepreneurs are realizing that there's an insufficient amount of resources available to complete all the projects that they've previously undertaken. That's like Mises' master builder example. A different way that you can understand this is to recognize that as this wave of inflation permeates out from the original investment, prices start increasing, and prices are also increasing because of the growing scarcity which is caused by more investments taking place than there are resources available to complete them. And as these market rates of interest, as these increases in prices force market rates of interest higher, they make marginal profits unprofitable, and people abandon them. This could be a housing project which is abandoned. This could be an R&D venture which has been abandoned. And once these projects are abandoned, people lose jobs, the bust starts to set in. To take it one step further, Mises writes in Human Action of what he refers to as a crack-up boom. A crack-up boom is the logical conclusion of a central bank increasing supplies of money to ward off this recession, to ward off the bust, and ending up with a hyperinflationary recession as prices keep spiraling out of control. Now, in that sense, when Austrians speak about the bust or the recession phase, we're completely different from mainstream economists, because the bust for us is actually quite a healthy phenomenon. All it's doing is exposing all of the errors that were done in the past. It's not a problem in and of itself. The problem was actually the unsustainable boom and all the investments that took place over the preceding years that shouldn't have taken place. And so the bust or the recession is just allowing consumers and producers to reassert their preferences in a sustainable way. And all it's trying to do is allow previously undertaken but ultimately unprofitable or unnecessary projects to be abandoned so that the resources can be freed up to pursue something else. In Mises' master builder example, this would be a bust could be the exposing of some home builders who didn't have enough bricks to finish their projects. And of course, those houses need to be torn down. Those projects need to be abandoned to free up bricks so that other houses can be completed. But that's not the problem in and of itself. The initial problem was too many home builders started building too many homes at the same time. The recession is just trying to clean up the mess that was previously undertaken. And the final note that I'll say is that delaying a recession in this way doesn't allow the structure of production to return to normalcy, which is important. We need to have a structure of production which is consistent so that all of our production plans can be linked together to produce consumer goods. To the extent that the boom misallocates capital along the structure of production, it creates problems that need to be resolved, which is exactly what the recession is trying to do. Any effort to try to stop the recession prematurely, or any effort that tries to halt this reallocation of capital along the structure of production, is only going to serve to delay the recession, delay the recovery rather, longer than would otherwise be the case. If anybody has any questions, because I know it's a complex topic, we can talk about them afterwards here because I've run out of time, or otherwise you can ask me during office hours later today. Thank you.
Okay, everyone, next up we're going to do pictures outside. So what we're going to do is just going to head down the stairs here. People will be directing you where to line up. It's going to be out by the conservatory, or right outside the conservatory.